Though, not that much, but that wage data coming in hotter than had been expected, even though it did show a drop down compared to the previous month. 122.95 is where we trade on sterling, and a lot of focus on the weakness in the yen. 151.63. How weak does it get? When do we see some intervention from the BOJ and or indeed from the Japanese government? And do we see the BOJ change its yield curve control policy? If so, when? Perennial questions around Japan, Tom.
And across the three main indexes, it is the FTSE 100 futures that is the standout on the downside so far, down about 0.1% according to the futures. DAX futures pointing higher, though, by 0.3%, Anna.
Okay, so that's the futures picture then, looking modestly positive, waiting for European equity markets to open up and waiting to see the start of that trade. I'm also focused on gilt trading then this morning, because waiting to see whether we see any response in gilt markets to what we saw in the labour market report. I can see, I don't have the whole curve here, but I do have the UK 10-year gilt in there. We see buying there, we see that yield coming down just a little. That perhaps, that's the 10-year horizon, and of course maybe the pound responding more like the 2-year might, but I don't see the 2-year jumping on my screen particularly at the moment, but it's early days. We'll wait to see what happens with the UK curve. More on the UK data in just a moment. This is the pound that we saw responding to that data, up by just 0.1%. Elsewhere, pretty quiet in FX markets. And this is the equity market story then right now. We've got positivity, this modest positivity across these European equity markets. The FTSE a little flatter, a bit of a laggard. We had some weakness in the iron ore trade. I know some colleagues were writing about through the Asia session. Maybe that's weighing on basic resource stocks. And commodities, you can see, entirely uninspiring, a very grey column. Maybe that calm, though, in commodities is a bit of a relief after recent volatility. But that's where we are, a sort of grey column for commodities. That doesn't set the stall out positively for the London market, and we see that underperforming. Tom, what do you see in the sectors?
Yeah, you're talking about the softness in the iron ore prices. Actually, the basic resources sector is actually posting gains so far of about 1%, and that's despite the fact as well that we're seeing further weakness in terms of the data coming through from China, at least in some of the initial data. When it comes to major sectors that are seeing some pressure today, tech down about 0.1%. Industrials off just by 0.1%. Not significant selling, but a little bit of pressure coming through for some of these sectors. Travel and leisure, maybe a bit of profit taking, was the leading sector yesterday in terms of the gains that came through. Today, just down 0.2%. Energy also posting some upside of about 0.5%. So energy in positive territory. Basic resources as well posting some gains so far in the session. Utilities currently up 0.3%, and autos up 0.5%. It's a mixed bag, really, as we wait for that inflation data out of the US. Across your benchmark, you're looking at modest gains of 0.1% at 447 on the European stocks 600 hour.
Okay, so modest gains across Europe. Yeah, interesting to see what's happening on basic resources then. And sticking with things that could be related to the basic resources sector, a red headline across the Bloomberg terminal tells me that the EU is considering extending its steel trade truce with the United States to avoid tariffs. And you might remember that there's been this truce in place around tariffs on steel, which has meant that they haven't had to apply them since the tariffs are expected to return automatically at the end of this year. So if there were to be an extension to the truce, that would mean a little bit of relief from this particular point of tension between the US and Europe, and it would mean some of the businesses in this sector escaping those tariffs in the short term. Let's put that to one side, though, and turn to what is making news on the markets today blog. Sam Unstead joins us once again from the blog. And Sam, we'll no doubt get to broader themes in a moment, but let me focus on the US with you right now. The US inflation story is going to be really key, isn't it? Tom was just pointing out, of course, we are expecting that headline number to come down quite substantially, not to the Fed's target, but still coming down, but not so with core.
Yeah, and I think actually, as you guys just mentioned, core is the key thing today. I think, we in the last few comments we've had from Powell and from a few other Fed speakers and Fed officials, people are waiting for that hawkishness to subside a little bit. Every time you hear them speak, they are pushing back a little bit, at least against the narrative of cuts coming anytime particularly soon. I think that core number, certainly if the core number comes in above, that will keep them on that kind of hawkish stance. Could even put a rate hike back on the table, but that will be the key number to watch today.
Okay, we're also going to be talking about the potential, or at least this downgrade or potential downgrade, negative outlook for Moody's, and the response from Janet Yellen, the Treasury Secretary, which is more of a kind of dog bites man rather than man bites dog kind of headline. Shock horror. She doesn't put much weight on it. She disagrees with that view. But the question really is about the resilience and the ability for the US government to keep funding itself longer term, I guess, is the bigger question.
Yeah, and this is kind of a long-running issue now. Every few months we sort of hear whether a rating agency is actually cutting or whether they are considering cutting, and then there's a kind of pushback from the US government, and each time it tends to come around the time that we are talking about a potential shutdown again, and that is sort of weighing quite heavily. And yeah, you're quite right. I think what else would you expect Janet Yellen to say to this? But even so, it's part of kind of a long-running battle that seems to be emerging between the US and rating agencies.
Yes, and very much linked, as they cited the dysfunction on Capitol Hill, didn't they? So very much linked to that US shutdown risk. I just want to get a quick check on what's going on in gilt markets, actually, Sam, and get your thoughts here, because, of course, the UK data, it was interesting to see the pound popped higher, but not by a huge amount, but it did pop, and that was the sort of direction of travel. And looking at broad bond markets, we've got actually yields falling across many parts of Europe and yields falling across the Treasury curve. But if I look at the UK story, yields are going higher, in fact, all the way along the curve. Not by much, but they are just moving a little higher. Yeah. I suppose telling the same story as the pound this morning.
Yeah, I think that's right. So we were kind of waiting for gilts to open this morning to give us a little bit of a better read. It does sound as if it's basically the same. Yes, the pound has gone up a little bit. It's been taken as very slightly hawkish, this data today. But as I kind of said earlier, I think now the key report now is the inflation report tomorrow, because there you will get a much cleaner reading on where the Bank of England may go after that. Because I'm afraid today's data, while it's still experimental, is going to remain messy until we sort of have a long enough data set.
1:30 p.m. UK time today, the CPI data out of the US. When it comes to the politics of the US, then, we've been kind of focused, of course, on UK politics over the last 24 hours or so, but US politics, a reminder that there is still deep division, and there's another shutdown potentially coming.
Yeah, as we were just talking about with the ratings agencies, this is part of the reason that the top ratings were taken away from the US by S&Ps and by Fitch. And I think, again, we've got today a vote coming up today for a temporary funding measure. They're going to require a pretty decent bipartisan support on that. Let's see. Let's see what happens later in the day. But certainly that continues to be an issue, along, of course, obviously, with the US deficit that is giving these ratings agencies pause for concern.
OK, Sam Umstead fielding everything from US politics to the moves in these gilt markets from our Markets Today blog. Thank you, Sam. You can get more detail, of course, more analysis, more hot takes from Sam and the rest of the team on the Bloomberg UK website or by typing TLIV. Go on the terminal. Coming up, we're going to look at your stocks on the move, including Glencore, which is trading higher on news it will buy a majority stake in Tech's coal business for almost $7 billion. The details next. This is Bloomberg.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sport fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today. It's 10 past 8, just coming up to 10 past 8, in fact, here in Europe. And Europe making modest gains, not really going anywhere in a hurry, though, after the handover from Asia was pretty lackluster. We were up by 0.3% on MSCI Asia Pacific, and US futures point very modestly higher. Let us get an update on some of the individual stocks that are on the move, though. Joe Easton has a briefing for us. Joe.
So Glencore rising around 4% at the open of trading here in London, following news that they are going to be the majority owner of Teck Resources, the coal company in Canada. They tried to merge with it 9 months ago. That was rejected, and they've come back at a 25% discount in terms of that price, and investors are liking that one today. Jefferies particularly positive in a note to clients on those. A couple of UK stocks that are marginally lower. Vodafone, we had in stocks to watch. The company did report some strong earnings in the latest quarter, but there is some disappointment about a lack of dividend news, given they are doing some asset sales, selling their business over in Spain and potentially over in Italy as well, according to reports just from last week. So that one is lower. Now, AstraZeneca ticking lower by around 0.3%. Breaking news that one of their lung cancer drug trials hasn't reached its primary endpoint in a trial, and that is disappointing. Might want to keep an eye on that one later to see if it extends those declines, but that one potentially a bit of a shock for them. Now, Delivery Hero, some really strong gross margins according to the company. This is, of course, the food delivery firm rebounding from those post-pandemic lows. That's the best performer on the stock 600 this morning, up around 6% at the moment. Another stock declining on the second board is a bit of a surprise as well. Now, Rolls-Royce, comments from the Dubai Air Show from the owner of Emirates Airlines saying they're holding back on an order for Airbus jets because of an issue with the maintenance time required for engines made by Rolls-Royce, and that is seeing that stock declining around 3% here in London. A bigger decliner over in Austria. This is an electrical components maker, sells into retail and maintenance shops. Now, AT&S dropping 15%. They're going to investors to ask for a potential capital raise, according to a statement from them that broke after the close of trading yesterday. Nordex over in renewables. This is the wind firm. It is a competitor to Vestas. They actually had some weak margins as well, down almost 3%, missing the analyst expectations, but it does seem like that was potentially priced in given those earlier profit warnings from the sector. And then Ørsted, the CFO and COO, both stepping down following the plunge in that one. They did around $4 billion worth of write-downs related to their US business just last week, and they are leaving the firm, potentially a reset in management there. So that one is down 0.6%. Over in Denmark, in terms of the ratings changes, we had these two in stocks to watch, and they are going the right way. So L'Oreal upgraded over at Morgan Stanley. They go overweight on that one. They downgrade Reckitt, so they're saying people are more likely to trade down on their household goods than their personal goods. Continental is an upgrade over at Citi. They like the electric vehicle response for that one. And Entain, downgraded by Jefferies. They were a buy for 5 years. They moved to hold, saying that MGM is unlikely to bid for the company, and that one is dropping 3%.
Joe Easton from my equity team. Great run through. Thank you very much indeed. Now, let's get back to the macro then, from the micro to the macro. And there is a stark divide in Wall Street and over how aggressive Fed cuts will be next year. Yes, there is an assumption from these markets there will be cuts. The market's pricing at about 3 cuts of 25 basis points each. But of course, the divisions are there amongst the houses of UBS, Morgan Stanley, both seeing deep rate cuts in 2024. On the other hand, Goldman Sachs, where analysts expect fewer reductions and a later start. Let's get the take then from Bryant Van Kronheit, who's the senior global equity portfolio manager and managing director at Allspring Global Investments here in Europe for just 3 short days. So, Bryant, we appreciate your time and for you coming on the show. Let's start with the big question then. On a day, of course, when we get inflation out of the US and how that informs the views in terms of the market pricing for cuts, and that is the expectation coming through from next year. But UBS taking a very strong stance and view that the rate cuts are going to come through deeper than many expect. They expect cuts of up to 275 basis points. 275 basis points by the end of 2024. You push back on that view?
I do. That's a very severe cut, and it only comes in a situation where the economy is crashing, essentially, and markets are pulling back meaningfully. I think the Fed's focus today is very different than what's been focused on the last 15 years. The Fed's had the benefit of quickly responding to economic contractions and injecting themselves into the market because they had a deflationary backdrop, subpar inflation to below 2%, so they could be quick to respond. The reaction function today is very different. Runaway inflation is far less socially palatable and politically palatable than a recession. And so today the focus will be on controlling inflation, not responding too quickly to a slowdown in the economy. And if we're going to see a cut of that magnitude, it's only because we are in a very dire situation, both economically and as investors.
Okay, so you don't expect there to be, well, it doesn't sound like you expect the outturn in the US economy to be that dire then, that's going to prompt that level of cutting. How weak do you think the labour market will get? I guess I'm asking if we're going to have a soft landing or something a little harder.
It's pretty clear to me we're going to have a recession. The degree to which we have a recession, though, is still very debatable. I'm not sure I think I have a great answer for that. But the reality is that the key to fighting the symptom of inflation is the disease of employment. The supply-demand imbalance in employment right now is the biggest concern for the Fed in my mind. And so they need to trigger that lower. They need to trigger more unemployment, essentially, to control wage spirals. Look at the labor issues we're having, not just in the U.S., but globally right now. Labor is taking back control from companies, and they're pushing wages higher. They're pushing benefits higher. And if they keep doing that, which is maybe justified in many respects, it's going to put upward motion on prices. And so the Fed has to control the supply and demand of labor. They're going to trigger more unemployment on purpose, thus triggering a recession. Now, how far we go is still up for debate. How quickly do companies respond to that is a common conversation we're having with our companies today.
And you've made it clear in your notes to us, you think that price stability mandate trumps the employment mandate for the Fed. Do you think, 525, 550, that level that we're at now with the Fed fund rates, that is enough to get that employment down to the level that you think is needed to get prices down to a more comfortable level for the Fed? Or do you see the potential? Is the door open still for further hikes from this Fed?
The door is definitely open, although I think we're pretty close where we need to be. We're starting to see the consumer crack a little bit. That's the first sign, right? We're seeing delinquencies pick up on consumer credit cards, on auto loans. We're seeing the banks pull back on lending, which will also contract the economy. So I think we're at a level now that's appropriate for what we're seeing in the data today. But the door is always open for the Fed to continue to move upwards with their rates if they need to get the job done. But I think we're closer than to the end of hikes, but we'll be here for a while, essentially.
Okay, we'll be here for a while. So that plateau, we'll still wait to see how sort of long and broad it is. Now, much of your dealing with Europe, I think, is through the Allspring Global Small Cap portfolio. And I think it's in there that you have a 6% overweight to Europe. But a lot of that, it doesn't necessarily reflect a positive view on Europe. It's a positive view on the rest of the world, the US, other places to do business. So which types of European companies are you looking to invest in?
Yeah, it's exactly right. We're overweight Europe today, but we do so in a relatively defensive manner. A lot of the bigger focus for us is not so much on the regional weight by domicile, but where are their revenues? And for now, we're actually more overweight the U.S. in terms of revenues, while being overweight U.K. companies and European companies. Where you're finding most of our exposure today are areas of healthcare and staples, areas that tend to have much more stable, predictable cash flow streams. And we want to own businesses that have balance sheets that they can use to play offense. If the world's going to go into a defensive mode, one of the most powerful ways to create value is play offense when other people are playing defense. And the only way to do that is having a really powerful balance sheet. So we're looking for our companies to go out there and make acquisitions when others are pulling back, to go out there and aggressively try to take market share by advertising and increasing the R&D when others are pulling back. Those are the businesses we own today.
Okay, so you're looking for that balance sheet strength when you're considering that overweight, that 6% overweight when it comes to European stocks. What about the commodities trade and how energy plays into that? We're hearing from JP Morgan, Klamich, Marco Cavallanch coming out and saying, sell equities, sell bonds, buy commodities. Is commodities, energy, basic resources, is that looking attractive? And is there a European play there?
Traditionally, at this part of the cycle, called late stage, late cycle, you want to own energy, and it has been doing quite well, as we've seen. Recent pullbacks in energy markets might be opening up opportunities for investors. Our view on this is we want to never let energy become the thing that drives our portfolio. It is highly unpredictable in comparison to businesses that are strategically deploying capital. So we want to have exposure to energy. We want to have it in a way that we're almost playing defense, beta blocking that category, but we're not looking at it as a place that you want to play offense today. I'd much rather own businesses in staples, healthcare, industrials that can more control their own destiny relative to that of an energy company.
Bryant, thanks very much for joining us. Bryant van Kronkite, Senior Global Equity Portfolio Manager and Managing Director at Allspring Global Investments, passing through Europe, and we're pleased to have him on the programme this morning. More ahead. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day.
Watch Chief Future Officer, Wednesday on Bloomberg.
We actually see that we come back to more of a normal market, I would say. But we've also had 2 years of a very, very abnormal market in a positive way, driven mainly by the component challenges, which means that we've seen continuously that demand has been bigger than supply. And now that's balancing out a little bit going into
so there's still a strong backlog, I would imagine. But is the new sales kind of weakening? Do you see that in the kind of demand going forward? I mean, obviously the backlog can carry you, but my question is kind of looking forward.
I mean, if if I look at the order intake and the backlog compared to the last 2 years, yes, it's slightly down, but in a 10-year perspective, it's still extremely good. So I think it's just more coming back to a normal market.
And you mentioned the supply chains. Are you now confident that you've got everything sort of under control and able to bring those kind of the trucks to market, and that's worked out?
Yeah, it's getting continuously better, I would say. We're still not really in like the normal situation. So we still work with shorter planning cycles than we would like, and we're shifting around sometimes in the production, but it's definitely going in the right direction.
And then last time we spoke, you said if you had one wish, it was to be a faster rollout in Europe of the charging infrastructure. Is your wish coming true?
That's still probably my top wish.
Okay, so still work to be done there. And then when you evaluate demand for the e-Actros 600, for the e-truck, and pricing kind of being a real main issue when you look at kind of the slowdown happening globally, what are you seeing there? I know you haven't started really fully selling them or producing them, but where do you see demand on the new truck?
Actually, I think we have our formal start of sales this week. So maybe when we meet next time, I can tell you more. But it's been very positively received. And when we were launching the E600, we also had a lot of customers visiting during the launch. And I talked to many of them, and they said this is really where they now start to see for some of their routes cost parity to diesel.
Okay, that was the CEO of Mercedes-Benz Trucks speaking to Bloomberg's Oliver Crook in Berlin. Now, from trucks to luxury watches, and prices for Rolex and Patek Philippe watches fell to a 2-year low on the secondary market last month. That is according to the Bloomberg Subdial Watch Index. It comes as demand for the pricey timepieces continued to decline amid rising supply. For more, let's bring in Bloomberg's Geneva reporter Andy Hoffman, who has the tough job of following the luxury watch market for us. Andy, prices then for luxury watches falling again on the secondary market. Is there any sign of recovery at this stage?
Tom, the good news, I guess, if you're in the market for a Rolex or a Patek, is no, not at this moment. You know, there's a lot of folks that thought things had evened out recently, but no, prices fell prices of the Bloomberg Subdial Watch Index down about 1.8% in October. Rolex prices down, Patek Philippe prices down, Audemars Piguet prices on the secondary market down. There is more supply, and it is taking dealers longer to sell watches. Obviously, we are well off the peaks that we saw in April 2022. That was after the boom that in demand for luxury watches that happened during COVID.
Yes, I was going to ask you about how this compares to recent history, because COVID, people sitting at home had more, in aggregate, more disposable income, spent some of it on watches, I understand, Andy. So how do these prices then compare to the peak? We're increasingly far from the peak.
We are. So we're at, you know, basically 2-year lows, which is as far back as we can measure the data for us. But, you know, at the peak, we are down from April 22 about 42% for the Bloomberg Subdial Watch Index. And, you know, Rolex prices have done a little bit better than others. They're down about 27% from that peak. And Patek prices down almost 50%, 47%.
Wow.
And so, you know, obviously, yeah, I mean, it's quite a decline, but let's remember, most of these watches still trade on the secondary market above the retail price.
Andy,
so,
thank you.
You know, that increase,
we'll have to leave it there, but that's a good point to leave it on. Thank you, Bloomberg's Geneva reporter Andy Hoffman. Thank you very much. We'll return to the aviation sector shortly. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Not there yet. European and Asian stocks tread water ahead of the US CPI data, which is expected to slow but stay above the Fed's 2% target. UK wage growth slows and vacancies continue to fall, but not as much as had been expected, complicating the Bank of England's inflation conundrum. Plus, Glencore gains as the commodities giant buys a majority stake in Tech Resources coal business, ending a months-long saga. So a bit of M&A corporate stories to talk about this morning. The earnings side, we spoke to Landsec earlier on, but also that Glencore story, really fascinating for many reasons. In terms of overall market moves, though, not great, not big, are they? Because we're waiting for CPI.
I mean, still treading water, and we get this, don't we, every time this print comes up. Treading water ahead of the inflation print out of the US. CPI, it is expected at the headline level to come down from 3.7% to 3.3%, but there is this focus and scrutiny on core inflation. Anna was right, of course, to point out the corporate story that is Glencore this morning. The last time I checked, that was the leading gainer across European stocks, and that is lifting basic resources as a sector. Across your benchmark, you're seeing those very modest gains then so far this Tuesday of 0.1% at 447 on the European benchmark. Over in Germany, the DAX posting gains of just 22 points at 15,367. Here in the UK, the FTSE 100 down by 11 points, 7,414, off by 0.1%. We had the slightly higher than expected wage data. It did come down, but it came in slightly higher than the expectations. And you saw the pound strengthening on the back of that, and maybe an adjustment to where investors think the BOE will go, possibly. Let's have a quick look at the sectors then. Basic resources was one that I flagged. In this yield environment as well, worth noting that the US 10-year, the last time I checked, was still below that 465 level, so slightly lower yields. We'll see, of course, if that dynamic changes later in the day with the inflation print and what that means for the tech sector. Currently, technology as a sector is unchanged. Basic resources, though, one of the lead gainers across the sector, the leading gainer, in fact, gains of 1% for basic resources. Again, Glencore is the key driver there. The auto sector also posting gains of 0.5%. Utilities, a bit of a safe haven tilt, up 0.2%. And banks in positive territory. A number of sectors, though, and it is a mixed picture this morning, in the red. Travel and leisure, after the gains of yesterday, down 0.6%. Energy also off by 0.2%, and financial services down by 0.3%. A very mixed picture this Tuesday. Just very modest gains at 447 on the benchmark of 0.1%. Anna.
Yeah, around three-quarters of sectors then in positive territory, led by basic resources, as you point out, even if overall these markets don't move very far in a hurry. Let's talk about the aviation sector, though. There's been plenty of news flow coming through from the Dubai Air Show. It's currently underway. Airbus confirming it's reached an agreement in principle on a major order from Turkish Airlines. That news came just around this time yesterday. Now, the Airbus CCO told us that demand is showing sustained strength.
see sustained demand, including on intercontinental travel. And we do see on the large aircraft, where fuel burn in particular and technology plays the biggest part, increased demand to replace old airplanes. So there's more replacement in the years ahead than there was before.
Joining us now is Sejal Varshini, Senior Equity Research Analyst at Alpha Value. Sejal, thank you very much for joining us. And of course, a lot of the focus in Dubai has been on wide-body aircraft, twin-aisled aircraft in focus. The Emirates order for Boeing, typical of that theme, the 777X. Has anything stood out and surprised you coming out of the Dubai Air Show, Sejal?
Well, it was quite expected that the demand overall will remain good, and we would see some superior quality and superior demand coming up from the Middle East. It's quite refreshing to see that the Turkish airline, it's almost like a deal in principle, and you have Emirates booking the Boeing 777 order, and even Air Baltic had confirmed that it will go for the A220, which is, even though it's a narrow body, but it's an upcoming aircraft, and we see pretty good demand overall.
Yeah, so the demand is there, and it's coming through from the airlines, as you say. But I guess the key question is to what extent the manufacturers, so obviously Boeing and Airbus, can meet that demand. Where are we in terms of adjusting to these supply chain constraints that the manufacturers are facing, Sejal, and where are the bottlenecks? Where are the choke points most acute?
So when we talk about the narrow bodies, the companies are ramping up their production, especially like Airbus. It has an order book for almost like till the end of this decade for the narrow body A320 family. So they are trying to increase their production level. They've set 2026 target, but as you said, there is some supply chain bottleneck. So it has been going on since the COVID. So right after COVID, I mean, you saw a pretty quick pickup in air traffic. So before going on wing again, these aircrafts needed some maintenance work. And therefore, like on the MRO side, that is the aftermarket, the repair and maintenance side, there was a bottleneck. So this is still existent. And not only that, like we see issue in terms of raw material sourcing, and there are some bottleneck from the engine manufacturer side, some suppliers like Spirit Aerosystem. So compared to the last 2 years, the trend in the supply chain troubles, it has changed. It's not like throughout the supply chain, but rather limited to a couple of providers.
Okay, Sejal, let me ask you about China and its intentions, because we'd previously seen China not buying any Boeing, Boeing aircraft. There was a sort of block on that, a freeze on that. According to our reporting, they are considering unfreezing the buying of Boeing aircraft, and that could see them order substantial numbers of 737 MAX. How significant would that be?
Well, it's kind of quite necessary, because the in-house Chinese airline manufacturer, it does not have like the international travel certificate. So when it comes to traveling internationally, China would still need a Boeing or an Airbus aircraft. So Boeing is quite popular in the wide body market, that is the double AL market, and therefore it could be substantial. Right now we are seeing that the Chinese recovery is not as fast as one expected, but it is set to increase in the near future.
Okay, so the C919, which is the domestic carrier, is for domestic purposes instead of international purposes for now. That's why they need still Boeing and Airbus. When it comes to the engine issue, Sejal, and this is a question we put to the Wizz Air CEO, the Pratt & Whitney engine issue. So inspections of what, 3,000 engines? To what extent are airlines adjusting to that? Is that a further headwind? Can we expect more inspections? What are you hearing on that side?
So this plan right now, it's for 3,000 engines. So we'll have some of these airlines, one after the other, announcing after finding out like exactly which engines need to be grounded. So we see that already Wizz Air, the Indian airline Indigo, they've already announced like 30 to 40 airlines that will be grounded for the same reason. So we can expect more news flow from the airline side. But from the engine manufacturing side, they've already kind of informed that it's about 3,000 engines that need to be inspected. And this number has been upgraded. So initially it was 1,200 that was announced in July. And then after like further inspection and further study, they've decided that around 3,000 engines have to go through that inspection. So I think for now, I don't expect major news from the engine manufacturing side about expanding this program to more number of engines, because it's limited to the A320 family aircrafts that were manufactured between 2015 and 21. So it's not for the new ones, but rather limited to the one that are already there. So the chances of expanding it is pretty low.
Thank you very much, Sidel, for the analysis and the context. Senior Equity Research Analyst at Alpha Value on the airline space. Coming up, fresh data out of the UK, wage growth slows and vacancies continue to fall, but not as much as expected. We get the context on that story. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The man who called and lost the Brexit referendum is back in government. In a surprise move, the former Prime Minister David Cameron has been appointed Foreign Secretary by the current PM Rishi Sunak. So here's a look back at Cameron's record in office. Facing a hung parliament in 2010, Cameron led the first coalition government since the Second World War, joining forces with the Liberal Democrats to become Prime Minister. His first major foreign policy test came in 2011, when Britain played a central role in NATO's bombing campaign in Libya. That helped to topple the Libyan leader Muammar Gaddafi, who was violently clamping down on protests. But the country since slid into brutal civil war and remains divided to this day. In 2013, Cameron failed to secure Parliament's backing for airstrikes against the Syrian leader Bashar al-Assad, who was accused of carrying out chemical weapons attacks on opposition forces. Cameron was also the Prime Minister who invited the Chinese President Xi Jinping to the UK, famously taking him down the pub for a pint. And relations with China are an issue that could catch up with him now he's back as Foreign Secretary. Cameron confounded expectations, winning a narrow Conservative majority in the 2015 general election. His key pledge, an in-out referendum on the UK's membership of the European Union. Cameron, who led the Remain campaign, faced off against Boris Johnson and Michael Gove in that referendum. He'd already notched up 2 referendum victories, first against voting reform and then against Scottish independence. But Brexit was a surprise defeat for Cameron, who promptly announced his resignation.
Okay, Bloomberg's Alex Morgan looking back at David Cameron's record in office after being appointed as the UK's Foreign Secretary. Worth pointing out that Alex Morgan is a man of many talents, but that was not him at the end of the tape. It was David Cameron.
Absolutely, because this sort of went viral at the time.
Yeah.
It's quite incongruous, actually, because he seemed quite emotional when he resigned, but then walked back into Downing Street, sounding like he had no care in the world. I remember I was on the Green in Westminster covering the time of his resignation. Yeah, a lot of news that day. Right, let us stick with the UK stories and dive back into the data from this morning. Wage growth slowed and vacancies continued to fall, even though wages didn't slow quite as much as expected. Those were further signs that the labour market is easing as the British economy flirts with recession. Joining us now is Nye Comenesi, principal economist at the Resolution Foundation, to give his take on the data set this morning and to think more broadly about the UK economy. Nye, very nice to speak to you. So the data today, I mean, some colleagues describing it as sort of something for everyone, because on the one hand, wages are coming down, which was expected, but they've not come down as much as had been anticipated. They're still sort of historically relatively high, and high relative to inflation actually now. What did you make of this data set?
Yeah, so I think that is fair, probably a mixed picture. So yeah, in headline terms, we still do have fast wage growth in the UK. So average weekly earnings growing by 7.7% in annual terms. That's obviously much higher than what the Bank of England would like it to be. It's not consistent with a 2% inflation target. However, if you look beneath the headlines and if you look at some of the higher frequency measures of pay data, and especially if you look in the private sector, I do think there are signs that the Bank of England's interest rate rises are starting to take effect. The high frequency pay measure has pay growth falling from about 8% in the private sector 6 months ago to about 4% now. So I think that is something the Bank of England would be happy to see. And alongside that, we do have continued falling vacancies. So in headline terms, vacancies now below 1 million, still up on pre-pandemic levels, but definitely falling, and falling particularly quickly in the private sector. So in big picture terms, I would say the UK still has a fairly tight labour market in the sense that it has a relatively high number of vacancies, low unemployment, and that is why we've got some of the faster pay growth we've had in recent months. But the Bank of England's policy does now look to be having effect, albeit only slowly.
Yeah, no, and we can unpack your views in more detail around the BOE, but I just want to kind of project out to 2024 that take that top line, there still is a relatively tight labour market in the UK. As you look into 2024, how does that adjust? How does that change? How much pain is going to come through for this UK labour market?
Well, certainly the Bank of England think that unemployment is going to rise. I mean, that's literally what they think needs to happen for wage growth to fully come under control. We're not yet seeing that happen in the data. So the ONS have produced estimates of the unemployment rate, which have it steady at 4.2% over the last couple of months. I would expect that to rise over the next 6 to 12 months as vacancies fall and as the economy continues to cool, which, as I said, is literally what the Bank of England is trying to achieve over that period. So that is what I'd expect. But it is interesting that we're not really seeing that yet in the jobs data. We are, however, starting to see it in the pay data. So we've recently, in the last couple of months, had this inflection point where wages are finally growing faster than inflation. Obviously, they weren't for most of the cost of living crisis, which is why most workers took a fairly steep pay hit. So we are now seeing real terms of pay growth. But obviously, if pay growth falls rapidly, that might not continue that far into next year.
That's been an interesting part of it, hasn't it, over recent months. Can I ask you about the data set and what we're getting from the ONS now at the moment? Because there's been a lot made of the fact we've got this quote-unquote experimental set of data coming through. I wonder if it's helping. Are you learning new things about the UK labour market. They had to change the way they collect the data, I think, because of the difficulty in contacting younger respondents about their labour market experience.
Yeah, so I don't want to get too nerdy here. This is something that people who spend all their time looking at the stats are very obsessed with at the moment. But a big part of what we know about the labour market relies on survey data, which is a surprise to some, but that's how it's always been done in this country and in other countries. So we have a very big survey called the Labour Force Survey, where tens of thousands of households are surveyed every month, and they're asked questions about their employment status, their job, and so on. And in the long term, there's been this problem of falling response rates. So fewer people are sending their survey back to the ONS, which makes it a bit harder to produce reliable estimates. That became a particular problem during the pandemic when they would usually do some door knocking. They didn't want to do that during COVID for obvious reasons. And so the data did become a bit more unreliable over the last couple of years. However, last month, on top of all of that, we had this surprise where the ONS said, actually, we've lost confidence in a more significant way, and they stopped producing a number of the outputs that we usually see. So they're still producing these, what they're calling adjusted estimates, or their headline numbers, but I definitely think that there's quite a large amount of uncertainty, unfortunately, at the moment with our headline jobs numbers. And that's obviously particularly problematic if you're sitting in the Bank of England trying to figure out exactly what's going on in the labour market. So yeah, from a data perspective, we're definitely not in ideal circumstances.
Yeah, and you wonder how much clean data the Treasury has. We have the autumn statement coming up towards the end of this month, Nye, and then, of course, the budget expected next year as we lead up to that election here in the UK. What are your expectations? How much room does the government have right now for fiscal surprises to pull some rabbits out of the hat in terms of spending?
Very little is the answer. I mean, we ran these calculations last week, and we showed that there is a very small amount of fiscal room. We would highly, highly discourage the Chancellor from using that to produce any rabbits out of the hat. Those numbers are, first of all, reliant on estimates of the pace of growth in the economy in 5 years' time, and I'm sure you can imagine that those numbers are subject to a fair amount of uncertainty. And I think just more generally, if you look at the last 10, 20 years, the story has been the debt position in the UK ratcheting upwards. So our policy said that has to fall in the 5-year horizon, but that doesn't account for the impact of sort of crises, which we have had roughly every 10 years. So our view is that you wouldn't want to use any unexpected headroom in the next autumn statement to cut taxes. We do, however, think that it would still, in that circumstance, be wrong, as has been discussed in some circles, to not go ahead with operating benefits in real terms. So the last 10 years in the UK, that has been used at some point by chancellors to save money. But I think coming out of the cost of living crisis, that would be the wrong thing to do. So it's not a time for tax cuts, but nor is it a time for real terms benefits cuts either.
Nye, thank you very much. Thanks for your time. Nye Comenetti, Principal Economist at the Resolution Foundation. Coming up on the programme, European stocks post small moves as traders await the US October inflation report. We'll discuss that next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
This is Markets Today, 54 minutes into your European trading day. Gains of 0.2% across European equities as we look ahead to the CPI print, the inflation print out of the US. Talking of the US, S&P E-mini is up 0.1%. Let's talk about what's happening then in these markets. Of course, inflation will be central to the discussion. Eddie van der Walt joins us from our M Live team to give us the context of the details, the analysis. So let's start with US CPI. What are we bracing for?
Yeah, look, there is an expectation that the headline figure will come down, that inflation CPI will start to fade a little bit, but the big thing is that core is expected to stay high, around about 4.1% on the year-on-year figure, and I think that maybe not changes the Fed's calculus, but it will change the bond market's calculus. The bond market will say, look, if inflation is going to stay that high, maybe we should trade. We should get more of a term premium in the Treasury market. We should see 10-year yields rising higher, and with the volatility we've seen in the Treasury market over the last week or so, I think that could be significant.
And
today.
talking of the volatility in the Treasury market, one thing people looked back to last week and talked about when we saw one or two auctions not going so well was the problems that ICBC were having because of a hack. And we have this coverage this morning that suggests ICBC has flown top executives to the US in a race to contain the hack fallout. This can have an impact on markets then, Eddie?
I think so, because this will be the real test, the first real test for the Treasury market since that volatility and failure really in the auction that we had. I think if we see any sort of, if we see a really wide deviation from the expected number in the CPI print, you could just see people really rushing to Treasuries. And then I think, if the market can't absorb that kind of volatility, because you've still got questions about whether, the ICBC is fully trading, that could have, implications for markets as a whole.
Eddie, just briefly, the market reaction to this UK data. Yields now down, and the pound has erased all of the gains of the session, 122 on the pound.
Yeah, look, I think it was a mixed picture that we got from the UK data, right? It's very hard to kind of read across. I think people will be tempted to say, look, the numbers were quite hot. We'd like to see whether that feeds through into the US as well. I think that's probably a hard case to make. But you know what? I think in the UK there is much more of a chance that rates will have to go even higher, just because this is an economy that's struggling.
Yeah, the market seemed to share that view initially, and now isn't quite sure, is it? But Eddie, thank you very much. Eddie van der Welt from the Markets Live team. Thank you to him. Remember, you can get up-to-date analysis from the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. You find Eddie on there, Nora Ali on there, you find Ben Ram, Mark Cudmore, all of our colleagues that we talk to regularly on this programme. That is it for Markets Today. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European and Asian stocks rise ahead of a U.S. CPI data, which is expected to slow but stay above the Fed's 2% target. UK wage growth slows and vacancies continue to fall, but not as much as expected, complicating the BOE's inflation conundrum. Plus, Glencore gains as the commodities giant buys a majority stake in Tech Resources' coal business, ending a months-long saga. So there's plenty of news going on. Happy Tuesday, everyone. This is what the European markets map is telling us. Now, again, a lot of the focus will be, of course, on those CPI figures a little bit later on. So stocks for the moment seem to be a little bit stuck. Maybe they're a little bit on hold before the U.S. inflation report. If you look at miners, the best performers in Europe's Stock 600, Glencore, we're just telling you about Glencore leading the gains after agreeing to buy this majority stake in Tech Resources. A lot will depend on inflation. If it does moderate as predicted, that may help cement the notion that global interest rates are peaking. The other story we're watching out for, of course, is oil. Now, I'm looking forward to our interview with Toro Bolzoni of the IEA shortly. At the moment, oil markets, they're coming out with their report saying that actually oil markets is a little bit less tight than expected. This is as supply is actually climbing. So we'll get through the report. For the moment, you can see WTI over in New York, actually at 78.43. Now, joining us now, as promised, is the IEA's head of oil markets division, Toro Bolzoni. Toro, as always, thank you so much for coming on. I know it's a busy day because you release it and then you make the time to come and speak to us. When you look at oil price actually slumping to a 3-month low last week, what has been the biggest impact, Toro, on some of these prices? Is it weaker demand or higher supply?
I think it's a combination of both. We're seeing, obviously, the macroeconomic sentiment is deteriorating. There's a lot of concern about interest rates and slowing growth. But what we're seeing is that oil demand is actually holding up strongly and exceeding expectation, as we note in our last report, especially China going from strength to strength. In September, Chinese oil demand was at another record high, above 17 million barrels a day, despite the bleak economic outlook. And we're seeing also, as you note, that supply from non-OPEC producers are exceeding expectations, with strong growth from the United States, Brazil, and other countries. So a combination of the two has eased the tensions in the market for the time being.
So, Toro, when you look at demand, has demand gotten worse recently? And if yes, where?
We are seeing some signs of demand destructions. As I note, China and the US has held up relatively strongly despite the economic outlook, but we're seeing signs of slowing demand, especially in Europe and also in OECD Asia Pacific, where in the third quarter demand fell by more than 500,000 barrels a day. We're also seeing signs of weakness in a number of African countries and globally. So really, the strength that we're seeing in demand at the moment is concentrated in a handful of countries. China, India, Brazil account for more than 90% of growth in 2023, and China by far the biggest contributor with more than 3/4 of the growth. So a handful of countries are driving the strong demand rebound that is coming out of the COVID pandemic. Jet fuel, China is driving growth and weakness in a number of other countries.
Toril, there's a couple of things that, and as we get into the report, so you've once again increased your demand forecast, right? You see growth of about 2.5 million barrels a day this year, but you're also predicting demand growth will actually slump 60% next year. So how do the two match up?
As I noted, the growth this year is really concentrated in a handful of countries, and this is China's rebound from the lockdowns that they had in 2022, and also jet fuel recovery from those lockdowns, not just in China, but globally. So a lot of the growth this year is exceptional, and it's a rebound rather than underlying structural growth. So as that recovery runs out of steam, as we're seeing now, we expect the structural factors to come into play, energy efficiency improvement, increasing EV sales, and also the weaker economic outlook projected for next year will take its toll. So we're expected to go back to trend or below trend demand growth from next year, and we're already seeing this demand slowing at the moment.
What are you expecting OPEC Plus to do? Many analysts think that they'll extend their 1 million barrel a day cut. Would that be a mistake?
So that's for OPEC Plus to see, and Saudi Arabia. They're obviously looking at the market very closely as we are. What we are seeing now is that the market is in deficit. We're seeing demand surpassing supplies in the fourth quarter, and we're seeing significant stock draws that could shift into a surplus in 2024 as demand slows structurally and seasonally at the start of the year, and if those cuts are maintained. But with inventories at crude oil inventories are at the lowest level that we've seen in our records, and the general inventory positions very tight, a return to surplus will be welcome for the market to reduce volatilities in the month ahead.
Toril, when you look at some of the analysis that we've had recently on Russian oil, it seems that some of the Western sanctions are not as working as efficiently as some initially thought at the start. So how do you see it developing?
So now it's true, Russian exports are holding up. In October, Russia exported 7.5 million barrels a day. That's still about 500,000 barrels a day less than they were before its invasion of Ukraine. But we're also seeing revenues creeping up as oil prices have increased, and the discount that Russia is getting for its oil narrowing from close to $40 after the invasion to less than $10 now. So obviously there's pressure on the international communities to reduce the revenues that Russia is getting from its oil. But we're seeing that with oil, increasing volumes of oil moving to destination outside of the EU and G7 countries and moving on maritime services outside of those jurisdictions, we are seeing that the discounts are narrowing, and the sanctions in place are having less of an impact on the price of the Russian oil.
I think we're also, when you look at some of the diesel demand in Europe, it's weaker because of weak economy. How does that develop going forward?
So it's true. In Europe, oil demand in the third quarter is down almost 500,000 barrels a day from a year ago. And most of that weakness is coming from the diesel market, but also from naphtha. So two fuels that are closely linked to industrial activity and manufacturing. And that has helped ease some of the tension in the diesel market. But even so, the inventories are low. The loss of Russian diesel and euros to European refiners means that the European diesel market is tight. So now Middle East has come up as the largest supplier of diesel to Europe at the moment. And with those flows slowing in the recent months because of maintenance in the Middle East, there is concern about meeting the winter demand in Europe in the coming months. And if we don't have a repeat of the warm winter weather that we had last year, we could indeed see that the market getting even tighter in the months ahead.
All right, Toril, thank you so much, as always, for joining us. Toril Bozzoni, they're head of the oil market division of the IEA. Now, we also got some breaking news of Glencore, one of the biggest gainers in today's trading session after it agreed to buy a majority stake in Teck Resources' coal business for $6.9 billion. Now, this is ending months-long saga and also setting the stage for the commodity giant to spin off its own coal unit. You can see Glencore gaining 3.2% intraday, and we also have Teck Resources pre-market up 4%. Now, coming up, fresh data out of the UK. Wage growth slows and vacancies continue to fall, but not by as much as expected. So we discuss that next, and this is Bloomberg.
Kenyan athletes are getting better and better, and the times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The man who called and lost the Brexit referendum is back in government. In a surprise move, the former Prime Minister David Cameron has been appointed Foreign Secretary by the current PM Rishi Sunak. So here's a look back at Cameron's record in office. Facing a hung parliament in 2010, Cameron led the first coalition government since the Second World War, joining forces with the Liberal Democrats to become Prime Minister. His first major foreign policy test came in 2011, when Britain played a central role in NATO's bombing campaign in Libya. That helped to topple the Libyan leader Muammar Gaddafi, who was violently clamping down on protests. But the country since slid into brutal civil war and remains divided to this day. In 2013, Cameron failed to secure Parliament's backing for airstrikes against the Syrian leader Bashar al-Assad, who was accused of carrying out chemical weapons attacks on opposition forces. Cameron was also the Prime Minister who invited the Chinese President Xi Jinping to the UK, famously taking him down the pub for a pint. And relations with China are an issue that could catch up with him now he's back as Foreign Secretary. Cameron confounded expectations, winning a narrow Conservative majority in the 2015 general election. His key pledge, an in-out referendum on the UK's membership of the European Union. Cameron, who led the Remain campaign, faced off against Boris Johnson and Michael Gove in that referendum. He'd already notched up 2 referendum victories, first against voting reform and then against Scottish independence. But Brexit was a surprise defeat for Cameron, who promptly announced his resignation.
Bloomberg's Alex Morgan there looking back at David Cameron's record in office after being appointed as the UK's Foreign Secretary. So there's a lot to talk about. Also sticking with the UK, wage growth slowed and vacancies continued to fall, but not as much as expected. Now, these are further signs that the labour market is actually easing as the British economy flirts with recession. Joining us now to discuss the data, but also to discuss the politics, Themos Fiotakis, head of FX research of Barclays, and Bloomberg's Adam Blanford. So thank you both for joining us. Adam, there's still this obsession, and I was at a couple of events yesterday about what David Cameron brings to the Tory party, what it means for the campaign, and actually just what it means on foreign policy.
Well, on foreign policy, that's obviously his new core brief, and it'll be very interesting to see where he goes on contentious issues like China, where the lay of the land has changed quite a lot since he was in power. You heard the package there talking about his outreach and his sort of friendly posture with Xi Jinping. Obviously, the US is much more sceptical of China now, and there are the winds within Parliament have changed quite considerably, with a lot more friction between on security and national security issues. On the EU, it will be intriguing to see how Cameron goes back into negotiations with the EU after the Brexit saga, and of course he's taking over at a time when there were 2 wars raging, Russia's war in Ukraine and obviously the conflict in the Middle East. So there's plenty there for him, but he's being pitched by the government as a capable, confident pair of hands who's been there and done it before. What will be interesting is to see whether that plays out with the voters who, he has had a record in office.
Adam, so basically, I mean, what would make a success of this new cabinet? Is it for Rishi Sunak and David Cameron get along and there are no waves? But, David Cameron is a big personality, so I don't know whether there's always a danger that he steals the limelight.
That's true. Although he's had his time as Prime Minister. Presumably, the mission has been agreed here that success would clearly be for them a creditable performance in the election. We can discuss about what that might mean, whether they're truly thinking of winning. But of course, the bullish outward statements will be that the Conservatives are trying to win an election by bringing back an elder statesman and a heavy hitter from the past.
So probably this should have moved pound more than it did, Themos.
It may. There's still time ahead. I'd like to pick it up from a key point. I think the market soon, at some point early in 2024, will start looking at the election in the UK.
Right.
And I think that there's been a considerable shock to trade and to prices from Brexit. Public opinion has taken stock of that. You can see that in many, many surveys. The opposition has taken stock of that in how they're discussing their own kind of agenda. And I think the government is now starting to think about how to adopt a line that will generally try to moderate, to assume the right kind of stance in terms of trade.
But so, Themos, what does it mean? If you look at sterling, right, from where it's now and where it will be, everything probably put in place by the cabinet and the government now will be to try and win the election. What does that look like? Is it more support to households that need it? Is it more kind of middle ground to make sure that they really go against Labour? And what does it mean for sterling?
Well, that's the important point. I think that ever since 2016, the pound has been in a range against the euro between 85 and 90. We have seen periods of time of strength, economic strength, have seen periods of time of economic weakness. It has traded weak to the euro. A big reason for that is the trade shock that we have experienced here and the price shock that we have experienced, supply shock. And I think that a key point for the pound is how do we create a trade setup, a positive supply shock in the next 4 years. And I think the closer we move to a degree of pragmatism in terms of carving out better supply situation from trade, it's going to be a positive for the pound, which is also what we think the market will start expecting and what we have in our new forecast published this morning, with euro sterling driving down to 84 next year at the end of next year.
And Demos, I want to ask you about the UK labour market data in a second, but overall, Adam, what do we know about what the priorities for Rishi Sunak are now? So obviously it's domestic, the economy, so that's the Chancellor, but then it's foreign policy because of everything that's going on in the world, the second most important thing to him.
That's right. There's those priorities he has. There's clearly a situation in the Middle East where the UK is aligned with the US, and that there's a worsening conflict that they want to stop worsening there. Cameron will have issues with China. The Foreign Secretary has involvement in everything from the range of from the AI conference to upcoming business and investment conferences with in the UK. So there's a broad range, but it's extremely interesting. Although James Cleverly, who's moved out of the Foreign Office, is into the Home Office, is quite has been seen as a creditable and well-performing minister. It's interesting to see what the change of tone might be, having moved Suella Braverman, who was divisive and some say controversial, out of government, and whether the Sunak administration will be trying to project a different public posture by bringing Cameron back in. It will be very interesting to see how it goes, because the last few months have seen quite a few different changes of direction.
Yeah, it certainly has. Demos, when you look at the UK labour market, look, it's holding up better than expected. I don't know whether that's something that needs to be applauded. In terms of what the market is expecting the BOE to do, it hasn't really moved that much.
Yes.
Because it's also a very tight labour market.
Yeah.
So it's still, maybe it's more of a construction problem of how, employment is behaving in the UK.
I think there's definitely some structural problem in terms of low supply and a pretty big gap in terms of the jobs needed versus the jobs supplied. But I do think also that we're starting to find out globally that the trade-off between inflation and labour market is much less onerous than we thought in the beginning. And the UK is still due some disinflation down the line, given global trends. So I think that, the Bank of England is striking an appropriate kind of a message where they're trying to see the impact of their actions on prices without necessarily being too pessimistic on the labour market, which I would agree with.
Okay, Themos and Adam, thank you so much. Adam Blanford, they're looking at all things politics, and Themos Fiotakis staying with us, because after the break, we'll also look at pressure on the yen with U.S. inflation figures out a little bit later. So a full FX roundup, that's next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Well, yen traders are bracing for U.S. inflation data, which could push the currency to a 33-year low and trigger government intervention. Yesterday came within a whisker of levels that saw intervention last year. Well, we're still with us, Demos Fiotakis of Barclays. Demos, when you look at yen, first of all, thank you for sticking around. When you look at yen, I mean, this is like more than an experiment. This is the hardest job in the world of central banking right now.
I think that there's definitely conflicting goals between the Ministry of Finance, the central bank, etc. What I would say is that the strong dollar is probably here to stay for at least another 9 months. And I would say also that if the yen moves in an orderly way, they have said as much to everyone that it's not about the level, it's about whether it moves with everything else. So they're not gonna, we're not going to be seeing a heavy hand from them unless it moves in a disorderly way. If you add on top of that they will be adjusting their policy, the central bank policy, but only very gradually, it's very unlikely to change this huge negative carry in the yen, which is a big negative factor for the yen. So overall, I think while it's shifting there in a painful way, it will probably break through these levels and move on to 153 or so.
Okay, overall, what does dollar do? So we're expecting the CPI, but this is, of course, this changes everything for all emerging markets.
Yeah. So I think that the CPI, it's probably going to be slightly higher than the previous readings. There's also this underlying trend that because of used cars and other sort of like disinflationary items abating towards the end of the year, though we might see a couple of strong prints as well. But I think that the bigger underlying point is that the U.S. has been a leader in disinflation, and now you're probably going to see other G10 catch up to the U.S. while the U.S. stabilizes in a slightly higher inflation. At the same time, the U.S. will continue to operate well above capacity for the most of next year, while other economies, including Europe, will probably start operating slightly below capacity, which will mean also that this convergence that is priced as interest rates is probably a little bit too optimistic. It will happen, but it will probably happen in 2025. So if you put that all in, we have revised our forecast for a stronger for longer dollar, with the euro dollar going to 105 until the middle of next year.
Demos, thank you so much. As always, Demos Fiotakis, their head of FX research at Barclays. Of course, plenty more on U.S. CPI after the break. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the next episode of the Business Week Show.
Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, it can be a positive step.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
European and Asian stocks rise ahead of U.S. CPI data, which is expected to slow, but to stay above the Fed's 2% target. UK wage growth slows and vacancies continue to fall, but not as much as expected, complicating the BOE's inflation conundrum. Plus, Glencore gains as the commodities giant buys a major stake in Teck Resources' coal business, ending a months-long saga. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So traders, of course, bracing for the U.S. CPI print out later today. Now, Bloomberg Economics says it's likely to show slower progress towards the Fed's 2% target, keeping the central bank biased towards more tightening. Now, core CPI probably gained 0.3% month-on-month, leaving the year-on-year rate unchanged at around 4.1%. Now, let's discuss all of this and, of course, this rates environment with Giuliana Bordigoni, Director of Specialist Strategist at Man Group. Juliana, as always, thank you so much for joining us. I know a lot of the conversations that you're having with clients is basically about these higher interest rates, where they end up, and actually what it means for the underlying economy and businesses.
Yeah, definitely we have seen higher interest rates that we have seen in more than a decade. And we are seeing the impact in few asset classes of these interest rates. Like one obvious impact is in mortgage rates. We are seeing mortgage rates in the US at the highest since early 2000. They are at about 7.7% rate. That they might have impacted the economy via the fact that people are not quite moving home because they need to refinance, and obviously refinancing is expensive, which means that if you have to take a job from another place, you need to put that into consideration. So that might have an impact in the economy. The other part where we are seeing the impact is obviously corporate borrowing. So corporations have put themselves ahead and they have tried to borrow on the longer term for many years when the rates were lower. But still we have about 3 trillion of debt that is coming into maturity within the next 5 years, which is a really chunky number. So we'll have to see what that means in terms of stress to corporations. At the moment, we are seeing default rate going up. Moody's estimates them around 4.5%. But what I'm trying to say is that they are up, but the situation is still fairly benign.
Yeah, which I'm surprised about. I don't know whether it's something that you surprised. I mean, you're really in the markets. You look at, quantum analysis. You're speaking to clients. Would you not have expected to see more distress to where we are? And, how difficult is it to explain this?
I think that the reason why the situation is not so distressed, I mean, in the mortgage space is because, as I said, the house prices have kept high, and they have kept, and they have kept high because there is little supply. On the corporate side, as I said, there has been provision through the years in order to make sure that to borrow when rates were lower for a bit longer time. And in general, you can see that corporates are a bit less levered than we are talking about in 2007. Now, obviously, it's a very different scenario. And when we talk about it, we always talk about, oh, this is like the highest that we've seen in 20 years, or is the highest rate that we have, the Bank of England. There was the headline earlier, the Bank of England rate is the highest in 15 years. So the point of is like that makes it the job of the quant that can't rely anymore just on backtest. So normally, when we build strategy, we think about the backtest, we look at what happened in the past. That's not enough. We really need to incorporate what we think is the outlook, what we think is some realistic assumption in our model. That is really the major change.
Juliana, when you look at COVID, has it changed, everything? Because people were saving, and I guess behavior has probably changed at the margins. I don't know whether it's changed enough to look at actually how corporates and also households behave.
I think, from my point of view, and I'm a quant, right, at the end of the day, but I think from my point of view, interest rates have changed more than the actual impact of COVID. So if you look at the impact of COVID, there is still some of it. I think that if you look at in the US, I think that US house supply is not as high, but not just from the household point of view, even from the construction point of view. We are not back at the pre-COVID level. But I think that what we are seeing from my point of view is really the impact of high rates.
When you look at, so what are your clients asking? A lot of the questions surrounding that, but are they asking also, are they looking at the models and asking you specific things that they wouldn't have asked a year ago?
I think that the major question we are getting is about cash efficiency. I think being cash efficient is more important today than it was when there were low interest rates. So that is the major topic that we are seeing at the moment. Obviously, now you have the performance of the fund versus a 5% rate, and that is the major point of discussion.
And that's actually going to be the case for the foreseeable future, right? Until interest rates start going down, which could be a long time away.
Well, if you listen to most of the banks, the central banks, they are saying that interest rates are there for longer. So it's going to be the case for a while. Yeah.
And Juliana, when you look at some of the quant analysis, how do you tweak it from, if not country to country, like region to region, because of some of the peculiar dynamics, I guess?
So I think that what we try to be robust, right? So when I was telling you about the back test and when I was telling you about looking forward, is really about building a robust model. And the more robust model is the one that works in different regions. So we really try to, obviously there are some region-specific effects that you may want to capture, but I think that the main idea is trying to be robust across regions.
You've worked actually in quants for quite some time, and I think you came on about, I think last year you came also on the program, we were talking about it for the first time. How has the models changed? How has it developed, and also client appetite for understanding this changed?
So I think that when I started, there was a lot of trend following, and loads of the research was about diversifying trend following across markets. So going back to your question, it was an effect that was present in many markets. We were trying to diversify across all the regions. Now what's changing is that we are looking more at effects that are non-trend following, and that they can diversify in terms of the signal. So it might be still across region, but it's not necessary, and it's really more about that. In fact, you can think of this year, one of the styles that has worked has been equity market neutral effects, and that has been one of the best performer this year.
But is that because the market is more complicated, or just because quant analysis has become better, more advanced?
I do think that we advance, right? I think it's more about advancing, it's more about improving signals and so on. But obviously there has been major changes in the market. We discussed earlier credit, right? Credit is one of the markets that has become more electronic, has become more automated. And that obviously has changed the dynamics, has made it possible for quants to enter into that space that maybe 10, 15 years ago was more challenging because it was all voice traded.
Yeah, that's such a good point. Is there any other part of the market that you're expecting quants to become bigger because the way the behavior of the market is actually changing?
I think that at the moment the focus of quant has been in the very liquid markets, right? I think that there is going to be more presence in the market that are maybe less liquid. That's what I see in the future. But the liquid market will be always the easier part for quant to trade.
I don't know about easier, but certainly you do it very well.
Well, I mean, in terms of like liquidity, right? So let me explain what I meant by easier. So what I mean is that when you go into credit, just to stay on the topic of the credit that we touched earlier, you are not sure if you're going to be able to execute. You need to put loads of assumption in. Am I going to be able to trade this bond or not? When you are in the liquid space, you don't have that problem.
Yeah, you have the data, so at least you can do the job of analyzing. Juliana, thank you so much for joining us today. Juliana Bordigoni, their Director of Specialist Strategies at Man Group. Now, let's also get you some of our other top red stories on the Bloomberg terminal this morning. And officials from the Industrial and Commercial Bank of China are said to have flown to the U.S. in an effort to contain fallout from a cyber attack last week. The world's largest lender is looking to reassure markets after a hack by ransomware group Lockbit prevented the ICBC from clearing numerous U.S. Treasury trades. Now, the bank is investigating the incident, but has not announced when access to systems of its offshore unit will return to normal. Google is paying Apple 36% of its revenue it earns from search advertising made through the Safari web browser. Now, the figure was revealed by Alphabet's main economics expert, Kevin Murphy, in testimony he gave in Google's defense in an antitrust trial in Washington. The partnership dates back to 2002, when Google became Safari's default search engine. And then unionized Starbucks baristas, that's something that's close to our heart here at Bloomberg, are planning to hold their biggest strike yet this week. Now, thousands of employees at hundreds of U.S. sites will walk off the job on Thursday, accusing Coffee Giant of refusing to fairly negotiate at cafes that voted to organize. Well, Starbucks maintained that it is the union that's refusing to fairly negotiate. Now, some other breaking news that we're having, this is actually just crossing the Bloomberg terminal right now. China is mulling $137 billion of new funding to boost the housing market. This is one of the measures that China has been putting in place to try and support the economy. Now, coming up, the push for safer AI. We ask IPN Chief Executive Officer Matt Calkins if the right people are regulating artificial intelligence. That's next, and this is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Season is here.
Tons going on, lots of earnings. Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of 2 earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Now, NVIDIA is updating the processor that has fueled its dominance in the AI computing market. The company says a new model called H200 will use high bandwidth memory to better cope with the large data sets needed for developing and implementing AI. Now, large computer makers and cloud service providers are expected to start using it in the second quarter of 2024. Now, my next guest says we're asking the wrong people to legislate on AI. Well, joining us now is Matt Calkins. He's the Chief Executive Officer and founder of the software development firm Appian. Matt, thank you for joining us. So who should we ask to regulate AI?
We should not ask big business. We should start asking the content developers. The biggest threat to me right now in the development of it, the regulation of AI, is protection of our data. So I want to talk to the people who create the data that's at threat. And that means artists, musicians, authors, people who have private information that's being trained on today. Their voice needs to be heard, and today we're talking mostly just to big business.
So, which we're regulating more in Europe than we are in the U.S. Who's getting it right? I mean, the Commission has, GDPR, like things like that, and trying to put in place to safeguard it. Should they do much more with AI?
Look, I appreciate the direction that GDPR goes in. It's about protecting individual data, but I don't believe it's been successful. I think the right way to do this would be for the government to intermediate between the inevitably lopsided contracts that occur between large organizations and individual people. You have to get in between that and say, for example, every person should be able to set the price of their own private data, and now it's up to big organizations whether they want to buy it, as opposed to every person now has to choose yes or no to whatever terms that a large organization puts at them.
But, I mean, Matt, this basically changes everything, right? If that's the case, then it becomes much more government or regulation heavy, and a lot of people don't really, when they sign a contract, fully understand what data they're giving away.
Right now, we all sign contracts with major internet service providers every day. We just click through and we say yes because we're at a great disadvantage. We don't know what these contracts mean. If the government were to intermediate and say now the contract means every person just sets the value of their data, now we would have a heavyweight on both sides. And today we have a heavyweight only on one side. And so I'd like to see a development like that. Neither government is today getting it right, and I don't believe that GDPR's efforts have been successful in protecting private data.
But Matt, just so I understand, this is not because they're using the data in a nefarious way. It's just because we're giving data free.
Honestly, in some cases it is being used in a nefarious way. There's a lawsuit by hundreds of authors today claiming that their copyrighted material was used to train AI algorithms, and from what I can tell, they're correct. They're correct. And the latest recommendation coming out of the White House says that AI can be trained on any of this information provided it is anonymized. To me, anonymizing my private information when it's used to train AI is not enough. I want my information to be defended, not merely anonymized.
Do you think that AI will go much faster, the development of AI will go much faster than we think it will, or much slower?
I'm expecting the development of AI to slightly plateau in the next few years. There's two things that improves an AI algorithm. One of them is the amount of data we feed it, and the other is the mechanism by which we translate that data into effectiveness. Now, we've largely fed everything we can into today's modern AI algorithms, and so we have to switch our focus to the harder problem, which is converting that data into effectiveness. And you'll see that proceed rather slowly, and so I think there's going to be a bit of a plateau in the next few years.
So how do you think it will be used? And when we talk about effectiveness, but this is, what does this look like? Is it job losses? Again, there's like worst case scenario, there's, better case scenario, but it's unclear where we end up.
Yeah, I don't think it's job losses. I think we're entering an era of mixed autonomy where AI is a complement to people instead of a substitute. I think the AI has shown that it can't be a substitute. The hallucinations, the problems, it's not going to be able to do this all the time. And if you look back 5 years ago, we would have been anticipating that AI would be driving our cars right now. Yeah. And we know that it's not, because an algorithm that makes a mistake 1 time in 1,000 can't drive our cars. And so instead, we've realized that AI is dependent on humans in order to make a good answer, and therefore we have a part to play for a long time. We're going to be empowered by AI. I don't think we're going to be replaced.
But I was in Singapore last week at our New Economy Forum, and actually we had this wonderful panel on, putting people at the front of businesses, and it's probably never been more relevant than it is now. So instead of regulating through governments, why not go back to labor unions?
Labor unions, did
Yeah.
you say? For regulating how we should use AI?
Well, for regulate how you use data. So if you have your union, for example, of musicians in the U.S., how much pressure can they put? Does it achieve the same kind of regulation that you're talking about?
A union essentially gathers the power of a number of people and provides a counterweight against the power of a corporation. That's one way to counterweight the corporation. Another way would be for the government to say, well, the way we should do this is everybody sets a price.
Yeah.
As a musician, if I wrote a song, I'd like to be able to say, AI can train on this song for $1,000 or 10,000 pounds or whatever amount it is, and then let the AI algorithm make that decision. Ideally, I think that's how it should work, and you wouldn't need a counterweight because the government would already be one. But there's many ways to approach this, and the union approach could work as well.
Yeah.
I just want to be sure that we're not all helpless in the face of a giant organization putting a contract on us.
So who's thinking about this? Who's doing it right? Is there one government or one politician that you think gets it?
I don't think they're getting it. I think that the statements that came out of Chuck Schumer's office, that came out of the White House, that came out of Bletchley Park, while all promising in different ways, none of them targets the fundamental issue right now, which is the privacy and safety of our individual data and what we create. I don't think anybody's focused on that, and the reason is the industry is absolutely not focused on that, and they're guiding the conversation in a way that's suitable for them.
Matt, thank you so much for joining us. Matt Calkins there, the Chief Executive Officer and founder of Appian. Now, coming up, Presidents Biden and Xi are set to announce a deal that would crack down on fentanyl exports when they meet in San Francisco tomorrow. So we look at what traders are looking out for next. This is Bloomberg.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
U.S. President Biden and his Chinese counterpart Xi Jinping are set to announce an agreement that would see Beijing crack down on the manufacture and export of fentanyl. Now, the two are due to meet tomorrow in San Francisco on the sidelines of the Asia-Pacific Economic Cooperation Summit. Now, let's bring in Bloomberg's EMEA News Director Ross Matheson. So, Ross, thank you for joining us. What are we actually expecting on this fentanyl deal?
Well, it's interesting to see that there might actually be movement on this because the US has been pressing China for many, many months to try and improve the situation when it comes to the crisis around fentanyl in the US, because China, of course, has the raw materials and the fentanyl that somehow seems to find its way through Mexico and into the US. So it's a very complicated situation, but at least sort of trying to cut it off at the source. And so far, China had seemed resistant to that. Now we're hearing there's going to be an agreement, at least a promise, to try and curtail the supply of fentanyl and its source material from China. At least whether that turns into reality may be another thing, but a promise to do so. And that's a really important development for US President Joe Biden coming into the election cycle in the US. Of course, the fentanyl crisis is severe in the US. It's something that he's promised that he wants to tackle, and successive presidents have tried to tackle and been unsuccessful in stopping. And so for Joe Biden, it's quite a goodwill gesture, really, from Xi Jinping, and a potential positive for him going into the election.
So Ross, this is something that the U.S. needs, especially the President Biden. What does President Xi want?
Well, he wants, he wants the meeting with Joe Biden to begin with, and that kind of being seen to be greeted in the US, treated on an equal footing by the US president. But also he needs things to be put on a better keel with the US because he's got an economy that's struggling, and he needs to stabilise that. He needs to stabilise his economy, his markets, his companies, and therefore his ability to hold on to power in China. So what he's seeking is actually just to sort of put a floor under the tension. So you're seeing these goodwill gestures, perhaps fentanyl. China's also buying soybeans now from the US. We won't see big breakthroughs either way, but at least, an understanding that the business ties between the two countries won't get any worse.
And that's, I guess, a win on both sides as we get into the election, year in the U.S. But there's nothing on chip makers, or could there be an escalation on foreign policy, or getting China to get more involved in the Middle East?
We're going to see cooperation on certain things where they agree they can cooperate, like, again, climate change, the gestures around fentanyl. China, it's an easy win for them to just buy some soybeans from the US. On the really hard stuff, like trade, technology, we're not going to see a lot of movement, potentially, but at least we're going to see some of the tension, the overall tension, dissipate. You'll expect the US will push China to take a stronger stance on things like the war in the Middle East, obviously between Israel and Hamas, and criticising Hamas, which China has not done, perhaps a firmer stance again on Russia over Ukraine. But those are things that China really does not want to get seriously involved in.
Does China want President Trump or President Biden at the next election? Do we know?
Well, that's the big unknown, actually, for a lot of countries, and not just China. At least with Joe Biden, you've got someone who's sort of more reliable, consistent. You can negotiate and deal with a presidency under Joe Biden because you know what to expect a little bit. It's a known known. With Donald Trump, it was obviously very erratic. He could change his mind on a given day. One day he would be speaking quite warmly about China. Next day he's in a trade war with China. So much, very unpredictable, and the Chinese don't like unpredictability. So it's hard to know, but, you can imagine that they'd say at least with Joe Biden they've got consistency.
Roz, as always, thank you so much for joining us. That was our Bloomberg EMEA News Director, Roz Matheson. Now, Sotheby's also sold, in other news, a rare 1962 Ferrari for nearly $52 million in less than 20 minutes. Now, it is the most expensive Ferrari ever to sell at auction, and the most expensive classic car sold publicly anywhere in the world this year, though the final sale price was lower than expectations. Now, it's also the only factory GTO Tipo 1962 to have been raced by Scuderia Ferrari, the automaker's Formula One division. And the Ferrari chief executive, Benedetto Vigna, actually features on this month's episode of Leaders with Lacroix, and that premieres next week. Don't miss it. It's a good interview, and we also talk a lot about going green. Now, also a lot of important conversations throughout the day today, including our exclusive interview with Citadel Chief Executive Ken Griffin. That's 6 p.m. London, 1 p.m. Eastern Time, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer, Wednesday on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Countdown to CPI data. Will disinflation stall as Wall Street remains divided over just how aggressive the Fed will be in cutting next year? A fentanyl crackdown is coming. Biden and Xi are set to announce a crackdown on synthetic opioid when they meet in San Francisco tomorrow. And the IEA says global oil markets won't be as tight as expected this quarter. We speak to the influential energy expert, Bob McNally. Very good morning. We have breaking news coming in from Germany. This is on sentiment. The ZEW investor expectations rises to 9.8 from 5. So let's just see, does that inject a new boost into the euro? You're trading at 107.19. Of course, the dollar has had a nice rally of late, but this is the euro dollar this morning, up 0.2%. Have we passed the nadir of negativity in Germany? We'll leave you with the thought euro dollar trades at 107.19. The question for the Fed, however, in the bond markets is, and we know that the Fed is wary of head fakes, is the disinflation story. That's the key. The CPI today. Has the CPI disinflation stalled? Yields drop ever so slightly, 4.61. This as it's going to help understand where the Fed's tightening bias is. By the way, going into these numbers, Bank of America's poll says we have the biggest bond overweight since 2009. The survey added 18% month on month. That takes the long position to nearly 19%. So the investor playbook for 2024 is a soft landing and lower rates. By the way, UBS just added to the controversy yesterday, 275 basis points of easing in 2024. I mean, that's got to be a heck of a hard landing for that. Dollar yen, yesterday we made a real big furore out of trading towards a 33-year low. But the risk for dollar yen is that you get a hotter CPI in the US. That emboldens the hawks and the hikes. 151.91 is where you want to keep an eye on. By the way, Japan Suzuki overnight jawboned the market as well there. And they will take appropriate measures wherever necessary. Oil is just giving a little bit back this morning, which is breaking off trend. The OPEC demand, brilliant piece from OPEC, says we've got overblown negative sentiment, Danny. There you go. Overblown negative sentiment, and it's all the fault of the speculators, if I'm not wrong, according to one or two of the biggest protagonists in OPEC. Danny.
You sound like the bulls talking about this equity or stock market. We have a pretty nice pre-market rally so far this morning. Can it last into today's CPI numbers? You'd assume that this equity market is looking for something on the cooler side. But nonetheless, S&P and NASDAQ futures both up about 0.2%. NASDAQ outperforming ever so slightly. Marko Kolanovic still not changing his bearish tune, as you'd maybe expect, saying the recent rally we've seen is just positioning. It is just short covering. You want to back off of this equity market and pile into commodities. Now, the focus might be on tech this morning with its outperformance, but it's going to be retailers throughout the week. We get Home Depot today, followed by Walmart, followed by Target later in the week. Finally, European stocks, those charting higher this morning too, Manus, up 0.2%. The best performing sector is miners, thanks to Glencore buying a majority stake in tech for just under $7 billion. So those shares up sizably this morning, again, helping the overall European market. pre-market rally. But Manus, when it comes to the stock market, we have a new call from Ed Yardeni. He sees stocks finishing at 4,600 by year end and sees a new record by 2025. He wrote in a note to clients late yesterday that the vigilantes are clearing the way for the stock bulls. In other words, that since the bear market ended, he thinks it ended in October 2022, that it's entered a new bull market. Now, the bond vigilantes and their concerns have retreated. And this is, again, his call of 4,600 by year end. So, Manus, there you have it. The man who coined the term bond vigilantes thinks that they're done now. He thinks they're gone.
He thinks they're gone. But that would tie up with the Bank of America survey, wouldn't it? Which is that they stacked up and racked up pretty significant long positions over the past month. So if we're no longer worried about deficits, we're no longer worried really about the pillars of stability in the bond market. We've got that investor playbook set. Bank of America poll, they're the longest they've been since 2009. It was a tricky year in 2009, just for anybody that forgot it. Danny, let's talk about the markets, because we've got the latest read on American inflation, as we've been saying. This is what we're set for. How much progress? We're looking at a plus 0.3% on the core, so the consumer price index, excluding food and energy, plus 0.3% for a second straight month in October. That leaves your year-over-year rate of 4.1%. That is the stage. Let's bring Andrew McCaffrey into the conversation, Global Asset Management CIO at Fidelity. There we go. The assumption is for this disinflation narrative to run out of steam. But I look at the positioning in the bond market, the longest they've been since 2009. So is that the bond market getting out of ahead of a flat piece of data to say 2024 is a year of disinflation? Let's be wrong, let's be long, and stack it up.
So I think on that, Manus, that what they're really saying is that they're going to look through this data again and look to where they feel the trend really is going. And that is that we are seeing that signs that the major peak has occurred, that now we've had a secondary period of small upswing, but that will be looking to decline as we go into 24. And also that the Fed is looking through and looking across a range of data, and some of those data points definitely point to a slowing economy. And so, again, as we see them tot up everything, that we will have a little bit of support, but it won't be necessarily just looking at today's data.
And meanwhile, the majority of market commentators continue to say it's a soft landing. Even some banks like Morgan Stanley see a lot of cuts, but still think it's a soft landing. You not so much so. Your framework is 60% odds of a cyclical recession. What does a cyclical recession actually look like?
So I think that's where we see a notable uptick in unemployment. So somewhere in the region of 4.5 to 6.5% developing over the course of 24 to 25. Now, I think the difficult part is timing. So we're in that it comes further into 24. So we're actually in a very interesting period where the markets can respond to potential in a Fed rate peak. You can see earnings staying reasonably robust. See the economy moving from a red-hot basis to a more moderate one, and actually trade for those slightly better outlook in the interim. But as we go further into 24, the risks start to pile up as the transmission mechanism and some of the indicators we're seeing now that are rolling over become more relevant to the market.
So cyclical recession, the risks pile up. Could you then see your way to, if I look at those three houses that have come out with their calls, UBS is going for 275 basis points next year in the space of 8 months. Could you see something as dramatic as that? Lumpy, large size, off the norm 25 basis point cuts in the scenario of a cyclical recession is a 60% case for you?
So we think unlikely, Manus, that we do see that cuts will come through, but I think that the only reason that you would see something as significant as that is if you see really that marked increase in unemployment accelerating at the time that we really do have signs that the inflation level is staying and getting close to that 2% area that the Fed is targeting, and that can be sustained for a period. We think that the reality is that's unlikely to be seen through the course of the second and third quarters, and so to get that level of rate cuts, it still seems unlikely to us.
Okay. It's interesting because a lot of folks out there in the market right now haven't been trading in that sort of environment where you're heading into a recession, but you still have that inflationary environment, which means you can't cut as much. Equities have been really sanguine throughout this whole drama, even as the bond market predicts cuts, which would, again, be something much worse. So once we get into that environment you're talking about in 24, where things start to turn, what actually happens to this equity market?
Well, I think that this really comes down to if earnings stay the way we have seen, which has actually tended to be more robust than many expectations, and that stability does continue, then equities can do reasonably well. But again, we have to look at what's already happened. The reality is that most of the equity market has not performed that well, and that it's been the Mega 7 that have really led everything through the course of the rally, and again are impacting now. And it's very interesting that they are almost behaving like a safe haven sort of trade in themselves. So I think that they will be an important part as we go into the early stages of 24. The challenge is, as we start to see unemployment rise, that as we see some of the consumer activity starting to roll over from that, as we see signs as well that inflation doesn't necessarily dissipate dramatically, but does continue to hold steady at lower levels, then the Fed will respond to those factors. And I think the equity market really only becomes very vulnerable if you see those earnings numbers start to turn over more radically, and it has to come in the Mega 7 as well.
Right. Well, let's face it, they've been able to price, a lot of companies have been able to price themselves up. Now, I like your scenarios that you put forward for China. Controlled stabilization, it sounds wonderful, but to that extent, how do they deliver controlled stabilization? Xi and Biden meet today. We'll talk more about that in a moment. He arrives not with a very strong hand. What is controlled stabilization? And more importantly, does that mean that you live with more China in your bucket allocation or less?
So really what we're looking for is that the combination of monetary policy and also elements of fiscal policy that continue to focus on stabilizing where they see levels of high risk, obviously the property sector, but also supportive across a number of different sectors. And we've seen actually, within the Chinese economy, a very vibrant technology base, which has also been very, very clear in terms of electric vehicles, in terms of green technology as well. But that's really broadening out. And what they're really trying to create is a level of confidence back into the domestic, corporate and individual environment.
Andrew, I love it. You're bucking the China pessimism and the U.S. optimism. Really great to get your thoughts this morning. Contrarian as ever, Andrew McCaffrey of Fidelity International. And of course, Manus, we're going to be getting some retail earnings on the deck too, so that will be interesting to see. But in the meantime, let's get to some of the other top stories that are trending on the terminal this morning. ICBC, the world's largest lender, flew top executives to the U.S. in an effort to contain the fallout from recent cyber attacks. The bank is investigating the incident, but has not announced when access to systems of its offshore unit will return to normal.
President Biden called on Israel to take less intrusive action at the Al-Shifa hospital in Gaza, stepping up pressure to reduce civilian casualties. Israel says Hamas uses hospitals as the basis for its operations.
Now, Bloomberg has learned that China plans to provide at least $137 billion of low-cost financing to the nation's urban village renovation and affordable housing programs. It's the latest effort to shore up the struggling property market.
Coming up, as President Biden and President Xi prepare to meet, we discuss the global issues surrounding the two largest economies. That's next.
And later, we're going to be speaking to Bob McNally, founder and president of Rapid Energy, on oil's relief rally and the latest comments from OPEC on Bloomberg.
think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank, and I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Talk about the slowdown in the Chinese economy, and I think agree that it presents a downside risk to the economic outlook that could affect probably not so much the United States, but many APEC economies that have deep trade relations.
Treasury Secretary Janet Yellen speaking at the press conference for the APEC summit in San Francisco. Now, at that summit, President Biden and his counterpart Xi Jinping are set to announce an agreement that would see Beijing crack down on the manufacturing and export of fentanyl. Joining us now is Roz Matheson. Roz, what exactly are we expecting from this fentanyl deal?
Well, it looks like China will agree to try and halt the supply of fentanyl and its source material, which is going mainly through Mexico and into the US, and of course, as we know, causing a protracted crisis, health crisis in the US. And China has resisted for many, many months the idea of cracking down from the source and the accusations that, in fact, they are the source of some of this fentanyl. But it sounds like Xi Jinping will at least make a promise at this meeting with US President Joe Biden to try and curb the supply of fentanyl into the US. How much in reality China can even stop the supply itself remains to be seen, but the promise itself is important because it will give US President Joe Biden a boost going into the US election campaign. Of course, he's promising to try and curb fentanyl use to improve this health crisis in the US. And so for Joe Biden, it's quite a win to get this promise, at least. Again, how much it translates into reality would remain to be seen.
Well, it's good to see. This morning I was looking at the New York Times. In 2015, he wrapped his demands for respect and reassurances. He quoted the tech executives while defending China's interests, and he denied that they were militarizing the disputed South China Sea. My, how things have changed. He's not arriving with that very strong economy behind him at this juncture. What is the tail risk for traders here? Is there a tail risk that there could be a floor on tariffs, that there could be an incremental move on tariffs? What is the biggest risk for traders on the outcome here?
Well, the biggest risk, I guess, for traders is that there's not a lot of tangibles out of this, or that any goodwill that we see from this meeting proves to be very short-lived. As you're saying, right now, there's an incentive for both Joe Biden and Xi Jinping to improve the relationship, at least stop it from getting any worse, and clarify the business environment, in particular for both Chinese companies and US companies, so that Xi Jinping can improve his economy. And of course, Joe Biden's got an eye on the election, but there's a lot of other factors at play. And so the question for traders is this a true flaw, an established flaw, or does it dissipate pretty quickly after the San Francisco glow of their meeting?
And, I just wonder how much of it can come out of things like oil, for example. Manis and I are going to be catching up with Bob McNally later. And, of course, China relies a lot on Iranian oil. And the U.S., it didn't pursue sanctions or tougher sanctions as many thought they would. There's some real big sticking points here, despite, again, trying to get a more positive mood music to come out of the meeting.
Well, that's why we're probably going to see sort of issues around where they can have shared goodwill and a common interest. So fentanyl is an easy victory for the Chinese to give. They've been buying soybeans again from the US, an easy goodwill gesture to make. Perhaps you get some things around Boeing, you get some stuff around climate change, common global challenges, but the real hard stuff, you know, that's still off the table. So we're talking technology, some of the issues around trade and business, where it's very, very difficult to see a lot of movement because Joe Biden arguably has been a more protectionist president than Donald Trump, just perhaps in a politer way with China, and he's got no great incentive to dismantle all of that now. And so, you know, all those difficulties around trade, technology in particular, oil, as you mentioned, those are probably going to go in a too hard box for this conversation. It's really about, can we have some short-term gestures and put a floor under the relationship?
Okay, Ros, thank you very much. Ros Matheson there with the very latest. Let's see what San Francisco brings for us. And it's interesting, though, isn't it? Because you look at the kind of commentary, Danny, that's come through from Martin Malone. And I was fascinated in the WhatsApp this morning from Oil Group. You've got Xi Albanese. You've got Xi Biden. Cameron's back on the world stage. Is this a November global reset?
And we were just catching up with Andrew McCaffrey of Fidelity International. During the break, as he walked off, he said to me, you know, one thing we didn't talk about is that there is a potential for further goodwill to come out of this meeting. Perhaps Biden announces a tariff come down, a rollback of some of the Trump-era tariffs. This is underappreciated, Andrew said, by the market.
And maybe it's underpositioned for that. I mean, if you just look, again, go back, you got Xi Australia, Xi USA, Cameron back on the stage. I don't know, I don't have an opinion on that. That's for greater minds than I, but he's back on the stage. Xi and Kishida, what if Kishida meets later today? So this is about a fundamental reset, which is critically important for the 2023 growth story, which has got implications. Okay, whatever China does may not have a huge impact on the US growth story, but it will have everywhere else in the world. Quick snapshot of bonds, CPI countdown to flatline, disinflation. This is what we've got. The bond market is as long as it can be. Yields fall ever so slightly, 461. Do you want to be long duration going into the CPI today? Core expected at plus 0.3%. Disinflation runs out of puff. Good morning from New York. Good morning, London.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
On the next episode of the Business Week Show. Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch The Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
It's Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger in London. It took 20 minutes. It cost $47 million. It's not your Christmas present. And the commission was 10%. What are we talking about? The Ferrari. It's a thing of beauty. This was auctioned at Sotheby's, Danny. 20 minutes, and it went from 34 million to 47 million bucks. 1962 330 LM.
Yeah, not too bad. This is a steal, Manus, sure. It's the most expensive car ever sold, but $51.7 million. The expectation was that it would be in excess of $60 million. So whoever bought this thing, Manus, got just an excellent deal.
They got a steal. Andiamo ragazzi. Francine would be proud of me with my Italian there. I think there was a Mercedes. There was a Mercedes. I know, it's dreadful. All the Italian viewers can now email. Ciao ragazzi. Yes, I've been to Ravello once. There was a Merc that was sold, a 300 SLR back in 2022, and that went for $142 million. But I think this one, I've got some facts. This actually was raced by, now I'm going to crucify this man's name, Scuderia Ferrari. There you go.
All right, you're never allowed back into Italy. I think that's what just happened.
No more pasta.
Okay, so Ferraris are hot, watches are not. Long Ferraris, short used watches is the trade. Manus, used watches, according to the Subdial Index, is at the lowest in 2 years. So there you go, Manus. You can finally buy me that Rolex you've been looking at.
I wasn't thinking about you. I was thinking more about myself. So, but then, you know, I always comes before us. There you go. There's your Rolexes. What do we see? The Subdial Index. So Rolexes are down 27% from their peak. You've got the overall index is down 42% from the peak, and Patek Philippe down 47%. What do you want for Christmas? You can say me and a Patek Philippe, you know. You can say both.
Yeah. I'll take that super rare Patek, Manus. Thank you very much. Going for what? 90,000? That's a steal compared to that $51 million car.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others.
Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Countdown to CPI data. Will disinflation stall as Wall Street remains divided over just how aggressive the Fed will be in cutting next year? A fentanyl crackdown is coming. Biden and Xi are set to announce a crackdown on the synthetic opioid when they meet in San Francisco tomorrow. And the IEA says global oil markets won't be as tight as expected this quarter. We speak with influential energy expert Bob McNally. Now, for this equity market, we are waiting for CPI, but we're not waiting to buy. Both futures on NASDAQ and S&P are charting higher this morning, up 0.2 for S&P, 0.3 for NASDAQ 100 futures. We're just speaking with Andrew McCaffrey over at Fidelity, who says even if we enter a cyclical recession next year, stocks can hold up because small caps have already sold off massively. It's the Magnificent Seven that's been supporting things, and balance sheets look strong, almost a quality play at this point. European equities, those move higher too, up 0.2%. And Manus, that's because the mega deals are back. We have Glencore buying a majority stake for just under $7 billion of tech. Those shares moving higher this morning, supporting the overall European equity index.
At least somebody's feeding the investment banking fees into the close of the year. You know, the sweet smell of a deal fee. Cyclical recession, 60% probability from Fidelity. But having a look at what's happening is the Fed's starting point is that we're wary of head fakes. That's why today's CPI data is important. Disinflation, CPI likely stalled. That'll reinforce the Fed's biting tires. As we go in, you see yields drop ever so slightly. Bank of America's survey has the biggest overweight on bonds since 2009. They've added nearly 18% to their exposure over the past month. So that takes them to a net long of around 19%. Now, UBS, of course, yesterday, they said that they expect 275 basis points of cuts to come through. Dollar-yen dips ever so slightly. We're still 20 basis points away from the 33-year high. You've got the finance minister out overnight warning that they're ready to intervene. So a lot of jawboning going on there. That's Mr. Suzuki in Japan. Brent manages to put on 0.25% in 30 minutes since we last spoke. But of course, the OPEC report says, I'm going to talk more to Bob about this, that the demand outlook is overblown with negative sentiment. But if it's Thanksgiving, and we know it is next week, you're going to be driving. It's going to be the busiest since 2019. I haven't got my American driver's license just yet. Danny.
Well, see, Manus, it's perfect because I don't have my UK driver's license. So you can visit me, be my chauffeur, and when I'm there, I can be your chauffeur. It works out perfectly.
See, I can steer and you can change the gears, or you can change the gears and I can steer. It depends which way you want to control the show. We know who controls this show, Danny Berger.
That is not true. We are both equal co-pilots. Okay, Manus, can we move on to oil? Because I feel like I'm going to get myself in trouble here. All right, the IEA says that global oil markets won't be as tight as expected this quarter. It boosted its forecast for fuel consumption. The head of the oil market division spoke to Bloomberg earlier.
We are seeing some signs of demand destructions. As I note, China and the US has held up relatively strongly despite the economic outlook, but we're seeing signs of slowing demand, especially in Europe and also in OECD Asia Pacific, where in the third quarter demand fell by more than 500,000 barrels a day.
Let's bring in Bob McNally, president and founder of Rapidin Energy Group. Bob, we'll give you the keys. You can drive the show for now, because this is something that you pointed out in your note. You talked about this idea that you have the IEA there talking about oil markets less tight than expected, but OPEC has their doubling down of their big deficit call. That is a big divide. Where does the truth lay?
Well, you know, it is. How unusual it is, Danny. Here we are halfway through the fourth quarter, and you've got the EIA saying we're going to have a small surplus this year. You have OPEC saying, no, we're going to have a 3 million barrel a day monster deficit. And now the IEA this morning coming out sort of toward the EIA saying it's going to be about a 900,000 barrel a day deficit, smaller than we had been expecting. So that's an unusual spread between official agencies. The truth is probably somewhere in between. That's where Rapidin has been. We'll probably be a little lower than we were last month, but the truth is probably somewhere in between. Look, here's the deal. What you can't argue with is that inventories have not been drawing by as much as folks expected, many analysts expected. That is the case. In the third quarter, we had big crude draws, but products were up. So far this quarter, we're seeing both crude and products draw. The question really is stocks at sea is kind of a foggy area, so we don't really know. But it's unusual uncertainty and differences among the official barrel counters this quarter.
So with that level of discrepancy, a lot has got to go wrong. I mean, it's an awful phrase, but an awful lot's got to go very, very wrong to end up with a deficit of 3 million barrels. But I'm not a PhD mathematician. The question is whether this brutal 12% sell-off, I know we've turned a little bit around in the past 24 hours. Do you think we're closer to a floor in this oil market at Brent at $82, but NYMEX sub $80? Or do you think there's a little bit more, let's say, weight to go on the downside?
You know, we think we're constructive, Manus. I think crude has more upside risks than downside risk here into the end of the year. I think the macro bearish narrative for oil has been overdone. As the IEA said this morning, demand continuing to exceed expectations. China in September topped 17 million barrels a day, a new record high. So the market has been climbing a wall of worry about macro when it comes to oil. What has been surprising is on the supply side, you have seen stronger U.S., stronger Brazil, Guyana. So you've seen a little stronger on the supply side. So maybe we're not as bullish as we were before, but we're constructive into end year, Manus.
So tell me then, Bob, do you think the Saudis will extend their 1 million barrel cut into next year?
I think odds favor them doing so. We had been expecting them tapering the cut in the first quarter, so withdrawing it gradually. Now the odds are probably toward a little longer of an extension. Why? The speculators are coming back. Minister Abdulaziz bin Salman does not like that. He said that publicly. Balances are a little softer. And look, it's clear Saudi Arabia is not basing its oil policy on the OPEC balances. If they were, they wouldn't have cut in the first place. So I'm not sure they're as confident as the OPEC barrel counters in these monster deficits. So I think they'll take a little more of an insurance policy out in the first quarter by extending the cut.
Bob, you can't come on the show and say, I'm constructive on oil to the end. You have to give me a level. You have to give me a bandwidth. You're not getting off the show with that. So come on, give us a constructive price.
I think we're going to be well into the 90s by the end of the year. You know, I think the market's a little complacent on geopolitical risk. Gaza, that everyone's forgotten about, it looks like from options, the price risk is zero. It's not zero. It's starting up with Hezbollah and Iran's proxies. That risk is not zero. We're not saying there's going to be a major oil disruption, but the risk is not zero. Also, look at the G7 is starting to crack down on the price cap. The Treasury just sent out letters to 30 countries looking to crack down on importers of Russian oil. So we're not done with geopolitical risk. And so I think between that and fundamentals, we'll go higher into the 90s, Manus, by Christmas.
Can there really be a crackdown on Iranian oil, for example, Bob? You have Xi in San Francisco with Biden right now. China is very reliant on Iranian oil. They're trying to get to some sort of agreement. Where does the future lay with sanctions in Iran?
So when it comes to Iran, the Biden administration doesn't want to mess around with sanctions. Why? Because if you start to crack down on Iran's oil exports, they will go back to enriching nuclear activities, and that will raise the overall threat level even higher. So the Biden folks, I don't think they want to touch sanctions on Iran. Congress wants to do that. I'm not sure the Biden folks want to do that. With Russia, it's okay. They'll take some risk, but not with Iran because of the nuclear weapons stuff.
Well, Israel has nuclear weapons as well. We don't have enough time to go down that road. The market is in backwardation. Your good nation is refilling the SPR. Contextualize that for our markets and what you understand about what's going on. Maybe that's the floor, Bob. Maybe that's the tacit agreement between Washington and Riyadh, which is you hold on to your 1 million barrels a day. You can even extend your lollipop. And you know what, guys and girls, we'll do a little bit of SP or filling. Is that a pro quo that works for you, Mr. McNally?
Well, first of all, this is man bites dog. Consider the Biden administration, to its credit, is filling the SPR with a war in the Middle East and oil prices still around $80 a barrel. That's pretty incredible. Shows how low the SPR has gotten. They really want to refill it. But no, I don't think there's a quid pro quo. We're filling the SPR at about 100,000 barrels a day. The Saudi cut was 10 times as much. So I don't think you'll see a quid pro quo barrel for barrel. But I think Riyadh is happy that the DOE and the Biden administration is starting to refill the SPR. I think that helps with the mood music, but there's not a strict quid pro quo.
Well, size matters, and that's where Saudi has it. You know, 10 to 1 ratio on the SPR. Danny, Bob, thank you very much. And he even gave us a price so you can come back. Bob McNally at Radford Energy Group.
Well done, Bob.
And getting up early for us. Danny, okay, what have we got? We have a little bit of a shutdown showdown. The House Speaker Johnson turns to the Democrats with his plan to avert a government shutdown.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. After only a few weeks in the position, House Speaker Mike Johnson is being put to the test and must try to work with Democrats to avert a government shutdown. Joining us now is Kevin Whitelaw, Bloomberg editor who's covered Washington for 25 years. So, Kevin, there's this planned vote today on his temporary funding proposal. What's the expectation for how this goes down?
Well, I mean, I think everyone's still, in a bit of suspense over exactly how it's going to play out. The measure that's that's on the table is a relatively clean spending extension, but it doesn't include any money for Israel, doesn't include any money for Ukraine. And it has a strange sort of two-tier deadline system. It expires at 2 different times for different parts of the government next year. But it doesn't include any of the steep spending cuts that Republicans were demanding. So the far right doesn't like it very much. Democrats are a little uneasy about it, and everyone else is a little bit puzzled. Having said that, I don't think anyone wants a shutdown right now, and this may sort of be the best way just to sort of delay some of the pain until early next year.
And then, of course, we got this red headline this morning. The EU is weighing extending its steel trade truce with the US to avoid tariffs. It seems as if there's a shift in global geopolitics, isn't it? In the past sort of 24, 48 hours, Xi, Biden, Cameron, here we are with the EU. There just seems to be a new step change, doesn't there, in terms of the movement? What can you tell us about the EU suggestion?
Yeah, I mean, I think in this case, the EU has really been signaling for a while that it doesn't really want a return to the tariff fight. It doesn't really can't really afford that right now. It doesn't want to have that kind of trade battle in the middle of a time where it's still basically flirting with recession in a number of economies. And so I think what we're seeing is now a much more serious conversation about basically pushing out any threat of those tariffs returning to try to give these steel and aluminum talks more time. Obviously, the two sides, the U.S. and the EU, are unable to reach a deal in a summit that in D.C. a few weeks ago, and it really sort of showed they're not that close to it. They're going to need more time, and this seems to be the best way to buy that time and to try to get past this this fight, which really neither side is looking to have, particularly ahead of the U.S. presidential election next year.
Okay, Kevin, thank you very much. That is Bloomberg's Kevin Whitelaw. Let's turn our attention back to the U.S. and the data flow. The CPI data will come out in less than, 3 hours? So let's bring in our resident expert. It is Mike McKee for more. Differentiate for us, what am I going to be most upset about? People are saying disinflation will stall. Then I've got another narrative, which is that super core may pop a little bit higher. What are you going to be super focused on?
Well, I'm going to be focused on the market reaction because that helps drive the Fed. And I saw a headline that worried me this morning on the Bloomberg terminal. It says traders push stocks futures up as they anticipate inflation cools. The forecast is for inflation to cool, particularly at the headline level, and to be unchanged at the core. But what if that is wrong? What if the core actually rises? That's not priced into the markets. And some of the people who think that we could see a surprise today are leaning toward the idea that maybe on an unrounded basis, we get a 3-digit rise to 3.05%. In terms of the core on a month-over-month basis, which would push up the year-over-year to 4.2, and that could really cause a concern. And here's one of the reasons why. This is health insurance. Once a year, the Bureau of Labor Statistics recalculates that. And you see how it was high for a year, and then for the last year, it's been negative and subtracting from CPI. This time, it is likely to add to inflation pressures at the core level. So there are some concerns that we could get a negative surprise today.
Mike, I do wonder about the inflation expectation, Jeannie. I know this is something you were looking at yesterday because we had those UMich figures which showed expectations rocketing higher. But then yesterday we get the NY Fed expectation reading, which was lower than expected when it came to the survey of consumers. How do you make heads or tails of these two conflicting reports?
Well, I suppose I would go with the Fed because it makes more logical sense. It's a little hard to understand the Michigan numbers, given that the Michigan numbers usually are tied to the price of gasoline, which is going to be a big reason that the headline CPI falls today. Gasoline prices down a lot over the last month. But this time we saw a rise for the second month in a row in consumers' expectations for one-year ahead inflation in the Michigan survey. And that doesn't make a whole lot of sense, other than the fact that they've been reading a lot maybe in the papers about the idea that inflation is not going away, and they translate that to higher inflation ahead. The Fed is also watching the markets, and the markets are closer to the New York Fed in terms of their forecast for where inflation is going, and so that gives them some reassurance.
You just mentioned gas prices there, and we get, I mean, I've come to live in America. I don't have a car yet. I don't have a driver's license.
Don't get one.
Well, no, but I have driven from here. I have driven from here to North Carolina. It's a long drive. But on that, we're going to have one of the, Danny brought this up, we're going to have one of the busiest driving seasons for Thanksgiving we've had since 2019. How important is this gas price to the overall consumer health? We're seeing savings drop off. Gas is critically important for the pocketbook, isn't it?
It is, and when gasoline prices go up, people get very depressed about the economic situation because it's something they see every day. They go out and they put gas in the car and they can see on the pump how much they're paying, and that takes away from other areas in which they can spend money. But the biggest thing that happens is that people look at gas prices and get upset when gas prices go above their previous high. And we haven't seen that, and now we've seen a big turnaround in gas prices, and they've come down a lot. So the question going forward, and we get retail sales numbers for October tomorrow, is does this mean people will feel they can spend more money for the holiday season? That's going to be an interesting question that retailers are going to be asking. We get a lot of retailers reporting over the next few days.
Home Depot afterwards. Don't worry, I've helped them out. I spent a few dollars.
And so what is their forecast going to be? It'd be interesting to see a store like Walmart, which sells gasoline, and how much of that they think will move from the pumps outside the store into the shelves inside.
Yeah, it's such a good point. Home Depot today, then we're going to get Walmart and Target later in the week. A lot between the eco data and the retailers. Mike, thanks so much. Michael McKee there with your little CPI preview. Now, coming up, we're going to have a little preview of what's ahead in the next 24 hours, some of the market-moving events to watch throughout the day. Manus.
Well, do we get obsessed by this CPI, Danny? Do we look through it? That's what Fidelity's view was. Strong profits, strong earnings. Let's have a look across your assets this morning. CPI, we're counting down. You've got S&P futures up 0.6%. Again, you are just seeing the dollar index flat at the moment. 10-year yields drop ever so slightly ahead of the CPI. Plus 0.3% is what we're looking for. Will we see disinflation flatline? Good morning from New York and London.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year. Most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Let's get you set up for your trading day with a look at what's ahead. The big event, U.S. CPI, 8:30 a.m. Eastern. The estimate is for 0.1% month over month, 3.3% year over year. Both of those would be down from previous readings. Then a host of Fed speak, followed by the data. We have Barkin, Barr, Master, Goolsbee, and Jefferson. Jefferson actually just speaking moments ago, all on deck. And President Biden heads to San Francisco while the APEC ministerial meetings kick off the summit. And so, Manus, we're going to start with Home Depot today. Later in the week, we're also going to get Target and we're going to get Walmart. We were just speaking with Michael McKee about this. What does that tell us about the consumer and just how much inflation is biting or preventing them from spending on big ticket items?
Yeah, I mean, I've actually been, because I've moved here, I need to buy stuff, just classic kind of stuff. A new TV that works with a plug. You know, so I have been into some of these shops, into Home Depot. I've been into Best Buy, looking for a TV. What's the other one? Costco. I haven't been there yet, but
you haven't?
No, I haven't. I haven't found Costco.
You got to, Manus.
I have found a few other clothes stores, but I haven't found Costco. But even on the sticker, on the bumper stickers, on simple things that I'm buying, like a vacuum, an iron, a TV, it's all 20, 30% off. So you're already beginning to see some discounts. I know it's the holiday season, and I know it's there, but you know, let's see. In terms of
that just reminds me. Wait, Manus, this is going to be your first Black Friday in America. Are you going to partake? Are you going to line up for the deals?
You see, Danny, I'm actually going to see you next Friday in London, and I'm going to go to Vienna. But you see, you don't even track when I'm coming. I'm traveling across the world to see. We're going to be reunited together next Friday. Look, on a more serious note, it is pretty significant, these discounts. You know, I'm in the market for a bunch of stuff. What else do you want to watch? I mean, you got a towing cost, and you make this call. Do you want oil or euro?
What's moving more? Maybe euro? Let's go euro. Why not? Strengthening versus the dollar.
Yeah.
Yes, the ZEW. You broke this at the start of the show, Manus. Is it the nadir of sentiment in Germany? It just might be with these numbers.
And therefore, that's got a big impact in terms of what happens with the ECB. So the euro, we made a session high. That was at the start. Expectations, we've turned positive for the first time since April. So that is optimism or misguided optimism. I'm not really that sure. I'm an optimist.
Manus, I feel like that's good. You're an optimist. You're coming to visit me, missing the Black Friday deals. We'll go shopping while you're here. We'll go to Bicester Village. We can get something nice.
Here we come.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
This is Bloomberg.
We're expecting a growth slowdown pretty much like the rest of Wall Street at this point.
We're not talking about a recession anymore. We're talking about a very soft landing.
It's going to be pretty fine if we're going to be between 1% and 2% GDP growth.
There's so much yield enhancement in this market that it's suppressing volatility, even on the equity level.
We're not in a recession. Look around. The economy is still growing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is CPI Tuesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P barely positive 0.1% on the S&P 500. TK 2 hours and 30 minutes away from the big data point of the day.
I think it's a big deal. It's like the auctions last week. It's a big deal. I'm going to look at this. You split it, obviously, core. You adjust for lower gasoline prices. And then will the rest of it all come down? And a lot of heated debate on this. It's going to be a mystery as we go to 8:30.
And then it's on to the Federal Reserve, Tom, where you will hear from Barkin, Mester, Goolsbee and Jefferson, and a whole host of Federal Reserve characters. You're looking forward to that?
Yeah, I'm really looking forward to it. I
Good.
like that Goolsbee of Chicago will do it with a sprightly attitude and not too much seriousness, but it's a little bit of over-communication.
You think maybe getting a ton of outlooks on Wall Street as well. We need to talk about a few of those. I want to talk about this first of all, though. The Bank of America Fund Manager Survey. Listen to some of these highlights. 76% of respondents say the hiking cycle is over, Lisa. 80% expect lower short rates. A record 61% expect lower yields. And just 6%, this is the standout, just 6% see higher CPI in 2024.
This is a big conviction call that bond yields have peaked, inflation has peaked, and from here on out, bonds will do well. What I thought was interesting within this fund manager survey was that investors were throwing away their cash in order to hold the biggest overweight position in bonds going back to 2009. This is a buy the dip moment that we saw really come into effect when that yield hit 5%. Can it continue? Does that conviction last? Through the CPI print today at 8:30.
Banu Baweja of UBS has said, jump on board. Let's buy bonds. Listen to this quote from Banu over at UBS. UBS's outlook here. We don't see the conditions for why this time is so different. Inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates, which are very high. Their outlook, Tom, early 2025, we get back to a one handle on Fed funds. So you've got UBS like right over here and Goldman Sachs somewhere 10 miles down the road.
I got a conviction call. It's just like it was 13 months ago. Go back to look at the certitude of 13 and 12 months ago going into year-end outlooks. I don't think this is any different. People are paid to take an opinion. It makes for good romance and theater with your clients. But other than that, I mean, come on. Somebody will be right. Somebody's going to take a victory
without a
lap
doubt.
out there.
But the spread, Tom, the separation between the banks, I think, is the story. We're not coalescing around one view. There is such little visibility about the next 18 months, Bramo, that we've got UBS saying one handle and Goldman Sachs saying back end of 24, maybe you get one rate cut.
This is the initiation of humility on Wall Street after what we got this year, right? Number one. Number two, we don't understand how much weakness there is, and we can go into some of the earnings, but I was just noticing Home Depot crossing, and one thing that they said was there is pressure on discretionary items. They seem to offer a more tepid view of what's expected in the year ahead, and these types of outlooks, I think, are giving people real pause. We don't know what's in the pipeline with long and variable lags. We don't know what discretionary spending is going to do. And that, I think, is really leading to some of this diversion on Wall Street.
Home Depot in the pre-market up by about 1.2% in early trading. Tomorrow, numbers from Target. After that, we'll get numbers from Walmart. We'll return to those numbers in just a moment. Let's look at the broader price action. Equity futures on the S&P 500, positive here by 0.1%. A little bit of a lift in this equity market. Yesterday, a total snooze across the board.
I was watching, got up from the surveillance
going nowhere.
Me and Vet Bill, 2 p.m. were watching, trying to wait for a pop here after 3 p.m. Just
hit snooze, honestly, yesterday. Quiet start to a really busy week. Let's finish on the bond market. Check out the yield curve. We'll fixate our attention on a 10-year maturity. 462 here, Bramo. Yields lower by a couple of basis points.
Yeah, people seem to be piling in. Jim Reed over at Deutsche Bank said this morning, markets have been extremely dull over the past 24 hours, so edifying what you were saying. 8:30 a.m., we do get U.S. CPI. People are looking at core, stripping out energy, given the fact that energy is probably going to disinflate given the declines that we've seen there. The expectation is for 0.3% month-over-month core CPI, which is not great for the Fed. This means it is not going down. It is going in the wrong direction. And at what point does that give some pause to the conviction trade right now on Wall Street? Weighing in on all of that, the Fed speak, and you were mentioning this before, John. Richmond Fed's Tom Barkin at 8:30. Fed Vice Chair for Supervision, Michael Barr at 10 a.m. Chicago Fed President Austin Goolsbee at 12:45 p.m. Interesting that these are all coming after that CPI print. Do they become a little more hawkish if we do get some sort of upside surprise? And today, as the APEC summit takes place in San Francisco, 9:30 p.m., there is a CEO summit, and this is what I'm watching most of all. Some of the CEOs who are confirmed in attendance: Jane Fraser of Citigroup, Darren Woods of Exxon, Satya Nadella of Microsoft, and Elon Musk of Tesla. There's basically a lot of interest in getting tickets to this dinner with Xi Jinping. The first time Xi Jinping has been in the United States since 2017. Executives are excited.
Now, be clear. You said today there's a meeting, and it's 9:30
p.m. There's just a summit for the CEOs who are going to be attending.
Without President Xi.
Yeah, because that had to happen after the meeting with President Biden, which was negotiating.
Which is tomorrow.
Yes, correct.
Okay, got it.
Is this invite only? Can you buy a ticket? How does this work?
I do believe you cannot buy a ticket.
Wait.
Hold on a second, because
Bramo said it's a ticket. I just wanted to know.
We got to stop the show.
When you're trying to do that,
just trying to find out.
Guys,
just trying to find out.
As we speak, John Farrell's negotiating Pitt Ferrari tickets in Las Vegas. So, John, what you could do is you could go to the Ferrari pit, and before that, you could go to the corporate
We go to APEC first, and then we'll make our way to Vegas after that. Okay, so you can't buy a ticket. Let's go to Greg Battle, US Head of Equity and Derivative Strategy over at BNP Paribas. Morning, Greg.
Good morning.
Busy 6 weeks for you. So let's go through the timeline if we can just a little bit. You were looking for a correction, got one. Then you got constructive tactically just for a moment, and now it's fade the rally. Is that right?
Exactly, yeah. The broader narrative has been one where we've been more cautious on the equity market, but we just think that it's a market where you have to be nimble, you have to be reactive. We saw a 10% correction, high to low. We thought the market was oversold, and it left us vulnerable to see a little bit of a reversal. We've seen that, and now we think the right call is to fade the rally again.
Why is that? Why is that the right call right now?
So we think we've seen a correction that's really based on a normalization in terms of rates, a normalization in terms of positioning, and we think the driver from here is more likely to be the bottom-up equity fundamentals, and we think that we're still in a downgrade cycle. And when we look out to 2024 and the bottom-up estimates, to us they look way too high, and one of the takeaways from the Q3 earnings season is that analysts are starting to take those numbers down, and we think we're in a downgrade cycle into the back end of the year, and we think that's going to just weigh on US
Talk about the
markets.
bull calls starkly opposite of you in breadth. They're assuming breadth comes on, right?
Yeah. So I think one of the obviously standout features we've seen has been this absolute lack of breadth from equity markets this year. And this recent relief rally that we've seen hasn't really shown any signs of that improving. And when we look back at Q3 earnings season, there's no signs of that breadth improving there either. I think one of the most startling takeaways from Q3 earnings season was the extent of the downgrades further down the market cap spectrum.
I mean, I'm looking at Home Depot coming out in the challenges, and essentially it's a pandemic pop to 400, and then they're churning around 300, and they've basically gone nowhere for a year. That pretty much describes a market in away from the Magnificent Seven, your correct call, and going nowhere.
Yeah, I think it's really hard to see that change because our view is that we are moving into a shallow recession at the start of next year. Whether or not that shallow recession manifests, I think the re-acceleration that's been forecast for some of the more cyclical names when you look at the bottom-up earnings picture isn't going to come through, and that's going to continue to weigh on those stocks. And again, when we look at the outcome of Q3 earnings season, the only names really seeing forecast upgrades post the event were those large cap names linked to AI.
Why won't Fed rate cuts cure all?
So I think if we get Fed rate cuts, they're probably going to get Fed rate cuts for a reason. And if you go and look historically at economic cycles, when the Fed starts cutting, that tends to be a signal to sell rather than buy because they're cutting for a good reason, which is the macro de-acceleration that everybody's been worried about is finally coming through.
This time is different. That's what everyone seems to be saying, that this time the Fed is going to cut rates, not necessarily in response to dramatic weakness, but simply because rates are going to become that much more restrictive as the economy slows. Why do you push back against that? Why do you expect the weakness to be more significant in certain pockets?
I really think it's just a question of what history tells us. The Fed tends to cut when they have to, and that tends to be a response to this de-acceleration in data. When we go from a Goldilocks environment into one which data slows, it doesn't tend to slow in an orderly way. I think the labor market is the best thing to look at here. It's very unusual to see unemployment just slowly pick up and a healthy amount of slack just emerge in the labor market. What you tend to get is something far more disorderly. When the Fed starts to get slack in the labor market, it's going to have to be a little bit careful what it wishes for.
This has been a really confusing economic cycle and a really confusing market cycle for a host of reasons, and not least of which is just that each industry seems to be moving at a different pace, at a different cycle economically. Could you see an area where suddenly even some of the small caps, which already are doing really poorly, could continue to get beaten up even as big tech continues to rally based on the fact that they can consolidate market share regardless of the market cycle?
Well, that's essentially one of the things that we've seen in this cycle. There is this kind of relative size advantage, and it also comes a relative balance sheet advantage. The biggest stocks are also those that have the best free cash flow profiles and the strongest balance sheet. So there's this relative effect of rates that it bites far further down the market cap spectrum. So if we do move into a kind of softening in terms of the macro data, it's unlikely that that's going to do much to narrow the breadth. Although our view is that if we do see a more significant economic de-acceleration, it is something that could drive more correlation, and ultimately higher correlation is what we need to see if we are to get a pickup in equity vol.
Can we pick a sector? Let's talk about the banks. Banks didn't work with really good growth and higher rates. They work with less good growth and lower rates.
I think banks are challenging. I mean, my views are somewhat scarred from having been in Europe over the last couple of decades, and you do see the effect of the risk the sector becomes a value trap. When we look at equities this year, chasing the cheapest stocks certainly hasn't been a trade that has worked. I think there's undoubtedly value to be found in the banking sector, but the question is if we are moving into a deterioration in terms of the macroeconomic outlook, is this the right time to be stepping into the banks? I would say no.
We're both conditioned by this, the European experience. Do you think US regionals could start to look like what's plagued Europe over the last 10 years?
I think in some respects they already do, which is that I think that they've become something of a value trap. So it's not obvious to me what is the catalyst outside of a kind of Goldilocks, very positive, super risk-on environment next year that's going to break us out of that.
What the heart of the matter here is the growthiness of the big tech companies All sorts of institutions and retail who've guessed right on that are loving 2023. You're saying we stay delinked in 2024. That's the heart of the matter. You don't really care what Apple does, do you?
I mean, I do a little bit, and I think there's actually differentiation between the large cap tech. One of the things that we've been saying is look to chase specific themes. So we think that AI and consumer are two kind of polar opposite themes. And when we look at the large cap tech, there are some of those names, such as Apple, which is a slightly more consumer-facing stock. So we do think that even within the mega caps, there is this potential for rotation, and those stocks that are more exposed to the consumer, even if they are large cap quality cash generative stocks, we think could suffer a little bit more if we see the economy tip into recession.
Greg, thank you, sir. It's good to see you. Greg Battle of BNP Paribas, very active over the last 6 weeks or so. I promised you we'd return to Home Depot, so let's talk about those numbers. Still looking for a decline in revenue. Just narrowing the guidance, just a touch. So this is the outlook now for full year sales, -3 to -4. Had seen -2% to -5% previously. We'll do the same for EPS as well. EPS growth full year, this is the guidance now, -9% to down 11%. The previous range, Lisa, down 7 to down 13.
And they talked about how there's ongoing pressure on big ticket discretionary categories, and this really speaks to this question of the disposable income that people have with respect to savings. It also highlights, as you look through the numbers, how much inflation's helping them. Basically, their sales volume is going down, but their overall sales revenue is staying about the same, partly because costs have just gone up for each of those items.
This week is a massive week for the consumer. For the consumer in America, how far can a dollar go? We'll get inflation a little bit later this morning. We'll get some insight to the consumer from retailers all week. Home Depot this morning, Target tomorrow, then on to Walmart. And then we'll get jobless claims Thursday morning. The same morning we get Walmart numbers. So a lot to look ahead to, including retail sales, that big data point just after CPI today. Equity futures just about unchanged from New York City this morning. Good morning.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
With regard to a potential shutdown, I understand that the new Speaker of the House has a proposal. It's being negotiated with the Minority Leader of the House and Senator Schumer and the Republican leader are also talking about it. I don't know what the outcome is going to be.
The President of the United States reluctant to prejudge the outcome of this week's talks in Congress. The House planning to vote today on Speaker Mike Johnson's temporary funding proposal to avert a shutdown. Greg Valliere of AGF Investments writing the following. In a bit of a surprise, Democrats are leaning towards accepting the proposal. Odds are roughly 60-40 that a budget deal can prevail in the next few days, but the bill will have one glaring omission. Tom, there is no funding for Israel and Ukraine, which may not pass until early next year.
This is really, really important, John. I think you're more read up on this. Why don't you bring in Greg Villiers this morning? But the partition here between Israel and Ukraine, these are two different studies, two different conversations.
Greg Villiers joins us right now, the Chief US Policy Strategist at AGF Investments. Greg, in your mind, from your perspective, in your opinion, do you think this can get through Congress this week?
I think they can. It's been so humiliating for them for the last few weeks. I think they know they've got to do something. The credit rating downgrade is serious. So, yeah, I'm at 60-40. I mean, it's possible that a handful of far-right radical Republicans could kill this. But I think they want to give, at least on this first bill, they want to give Mike Johnson a victory.
This is what I was going to ask, Greg. Who does this particular offer upset more? Is it Republicans within his own party or elsewhere?
Well, it's a good point, John. There's so much in the bill to hate. For the conservative Republicans, there are no spending cuts, and they're quite upset over that. For the White House and the Democrats, the fact that there's nothing for Israel or Ukraine is very troubling. And we can say, oh, we'll get them some money in February. Well, they need money now. And I think to not send our allies this money sends a very bad signal.
Greg, it's that time of year. Our Greg Giroux owns a high ground on keeping track of who's leaving, who's coming, who's going in the House, in the Senate. Juan Williams in the Hill today, or yesterday, I should say, really writes it up of the Republicans leaving the House. I think this is underreported. You've got Buck, you've got Granger, you've got Lesko, you've got Sparts, on and on. Is this going to be even a more Trump Republican Party, not in a year, but in a matter of weeks?
It could be, yes. And a lot of the names you mentioned are people who are disgusted. They can't take it anymore. I also think there's a growing chance, a very good chance, that the next Senate will elect a year from now will be controlled by the Republicans. They have, I think, an easy chance to take the Senate.
You know, I look at this as wildly underreported. You know, the focus on Manchin and that in Spanberger, Virginia. Have you seen it like this before? Is this normal changing of the chairs, musical chairs, or is there something unique here?
Well, I tell you, Tom, I think what is unusual is to have Democrats talking now openly about a need to get a different nominee. That's really unprecedented. You probably have to go back to LBJ, who lost support in his own party. That makes the Democrats nervous, the fact that they could lose the Senate and lose it convincingly.
We'll get back to that in 1 second because I do want to get your view on that. But just to build on what you're talking about, the fact that Democrats are joining with Republicans, some of them, to back Mike Johnson's plan. Isn't this what got Kevin McCarthy ousted as House Speaker?
Bingo. That's right. And I got to think that we could have a repeat. You only need like 3 or 4, at the most 5 no votes, and this whole thing could fall apart. So I think that Johnson has to worry that he could suffer the exact same fate as Kevin McCarthy.
And there still are at least 9 ultra-conservatives in his party who are going to vote against this, at least as for now. What's worse, though, on an international stage? You were talking about no funding for Ukraine and Israel. Is that worse than a government shutdown in the U.S.?
I think a government shutdown is become so ordinary. A brief shutdown wouldn't be as serious as sending a signal to our allies that we can't support them. I mean, this, I think, is really very, very unnerving. One other point I'd make quickly. I do think the final outcome is Johnson having to cut a deal with Democrats. I think that's the only way we're going to get a deal in the next week or two, is to have the two parties unite on this.
What will be the ramifications of that? I call that doing a John Boehner for our international audience. We've seen this before. But then what is the outcome if he does that?
The outcome is going to be an effort to oust him. I still think it's less than 50-50. I think they want to give him a victory, Tom, but you could see a lot of Republicans say this is totally unacceptable.
Greg, let's talk about the race for the presidency next year. The field is narrowing on the Republican side, and it looks like Nikki Haley's starting to attract some money. What do you make of the moves we've seen in the past week, Greg?
Well, Tim Scott didn't surprise me in the least. I think that the strongest, other than Trump, of course, has been Nikki Haley over the last few weeks. She's got real momentum. DeSantis does not. He didn't even mention his endorsement in Iowa from the governor. I can't figure out.
That was so weird. Can I just jump in? What was that about? Yeah. Why didn't that come up in the debate?
I don't get it. She endorsed him. I'd be bragging about it, but he didn't even bring it up in the debate. That was mystifying. But it's still Trump's to lose. Trump has said some extraordinary things in the last few days about how his opponents are vermin, using really, even by his standards, exceptionally harsh language. But his numbers hold up. He still has the base.
And that means we need to narrow the field potentially even more for the Republicans. Who's next to drop out, Greg?
Maybe Ramaswamy. He's got money, but I could see him drop out. He's got no traction. His numbers don't look good. I think DeSantis and Nikki Haley stay in, and probably Chris Christie stays in, and that's good theater.
Well, at this point, maybe the field is narrowing on the Republican side, but in some ways it's actually widening on the Democratic side. You said that there's real fear and there are real calls within the Democratic Party to have some other options than President Biden. How realistic is that? Who is everyone coalescing around?
Well, that's the problem. Nobody. And I think one of the strongest things that Biden has is the lack of any clear successor. And I think because of that, he will be the nominee. Apparently, in the last 24 hours, he's been very angry, profane, criticizing people like David Axelrod. I think he feels that he should be the nominee. I think he will be the nominee.
What do you think he's upset about, Greg?
Oh, mocking him for his age, probably more than anything else. He can't do much. Can't do much about that.
That's true. Greg Valliere of AGF Investments. Don't think any of us can do anything about that, Greg. Appreciate the update, sir. To Bramo's point, TK, that question just won't go away for this president. I can see why it annoys him, but ultimately it's a question being asked within his own party, not externally, not outside of it.
And it's percolating for the former president as well. I'm not up to speed on the exact anecdotes, but people are a bit mystified by misstatements by President Trump and President Biden. It's equal opportunity.
Well, and then you have all these independent potential candidates, and who does that hurt more? And that raises this question of, can we actually get a viable independent candidate? A lot of people say it's never happened before. It doesn't usually work that way, and it's just a matter of whose votes they cannibalize more, the Democrats or the Republicans.
I just want to point out, John, this word vermin, and it's a really Merriam-Webster. It's an ugly term, and he's really been some serious
it's a loaded term,
criticism, noxious, objectionable, or disgusting. And what's so tragic here, and John, probably in your depleted English childhood, you missed that. What the president could have done is gone for the Southern vote and gone all Yosemite Sam on us and said something like, "Why, you no good varmint." That's a famous Disney line.
You might need to tell me more about my depleted childhood.
That's a Warner Brothers line there.
What
Do you know who Yosemite Sam is?
No.
Okay, Warner Brothers. And if President Trump had gone in there with a Yosemite Sam riff, he would have scored major Southern electoral
You lost
success.
me at depleted childhood, to be honest.
Bugs Bunny. It's an offshoot of Bugs Bunny.
Okay, good to know. Thank you.
Coyote over the cliff.
All right, and it sort of stands there with the legs racing. Yeah. Okay.
Say your prayers.
I still don't know where this is going. Coming up, Julia Coronado of Macro Policy Perspective joining us very shortly. It's a big week ahead for economic data. The week begins this morning. Inflation data about 2 hours away. Then on to tomorrow morning, you'll get retail sales in America. In between, tons of Fed speak. You'll hear from whatever Fed official you want to hear from. Who's your favourite? You'll hear from them later this week. Do you have a favourite, Brahma?
Yeah, I have a couple favorites.
Do you?
We're not going to
Do you
speak
actually
for the
have
day.
a- oh, you have
Well,
favourites?
there's some people who actually say something, and then there's some people who don't, but they keep speaking.
Do you want to tell us which one that is?
No, I don't.
All right, maybe people can guess. Equity futures on the S&P, just about positive. Live from New York City this morning. Good morning.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
What a snooze. A start to a very busy week, a quiet start to a very busy week in this equity market. Your equity market right now looks like this on the S&P. We're going absolutely nowhere, up 0.04% on the S&P 500. Quiet start to what is really a very busy week. We'll be talking about CPI throughout this morning. That data about 2 hours away. Looking at the bond market, the 2-year, 10-year, 30-year shaping up as follows. The 10-year yield down a couple of basis points, 461.81 on a 10-year. The 2-year, just north of 5%, 5.03%. On a 2-year this morning. Just to finish on foreign exchange, quick sneak peek of what's happening in the euro, climbing for a second session yesterday, up again today, 3 days again, it's 107.19 on the euro against the dollar. There's your price action, Bramo, 0.2%.
I'm just so impressed. We've got 107. This is exciting times in the Euroland.
It's all happening.
Yeah.
I mean, I'm joking. It does get more interesting as the week progresses, I promise you. CPI, 2 hours away. Looking ahead to that inflation data, the median estimate in Bloomberg's survey calling for a headline CPI read of 3.3%, down from September's 3.7. Wall Street's biggest banks estimating a 0.3% rise in core CPI month over month. Bramo, does the disinflationary story start to stall going into year end?
If we get this kind of print as expected, yes. And this is a problem. It's moving in the wrong direction. We're not getting the disinflation that people expected. You dig into the technicals, and it's because of healthcare reevaluation of exactly how they price inflation with all of your expenses from medical bills, which we all know are going up pretty dramatically. Here's the question to me is, how does the market respond? What's the potential bigger disruption in markets, an upside surprise or a downside surprise, given that everyone seems to be clamoring in on a bond bet? And this might just give them the all clear if we underwhelm with the inflation.
The Citi's Andrew Hodenhorst says it doesn't really matter how big the upside surprise is, Tom, that ultimately this bar is so high now for another hike from the Federal Reserve going into year end. Maybe this doesn't matter as much as it used to.
Yeah, I'll go with that. I think it's at a critical point here, and I'm not really sure which to focus on at 8:30. Do we look at the non-gasoline, non-oil reduced numbers of the actual all-in pie? I'm going to do what David Rosenberg would do, which is just tear it apart. And there's going to be a lot of deflationary goods and even maybe some deflationary service sector